Continuing fluid through the week against Stephen Aarons in Frankfurt, observing European banking, and we'll talk about that in a bit. Adam Posen will join us in the 8 o'clock hour with his most important essay of the weekend. Right now, Dr. Thin joins us. Win Thin is Global Head of Currency Strategy at Brown Brothers Harriman, and far more than that, a student of the Pacific Rim. Win, what do you glean if it's not monetary policy, but regulatory policy is this crisis? What do you glean about the new economic slowdown and that China may miss the mark on 6% economic growth?
Yes, first of all, good morning, guys. Thanks for having me. So, this past year, the two main drivers have been Fed policy and China COVID-0 and reopening. And everyone got bowled up on the China reopening story, but really the data since then have really been very disappointing. The official PMI for March will come out later this week, expected to show a significant drop. And if you look at the export order numbers out of China, Korea, Taiwan, they've just been really just a blip. And so, it seems like China's going to struggle. I call it the year of living dangerously for President Xi. It's going to struggle to meet even the 5% growth target that's set. What does that mean? It means global growth is going to remain under pressure. China's not the savior. We know that the U.S. is slowing. We know pretty much the whole world is slowing. So to me, the big investment punchline I got out of this is to remain negative on emerging markets. Right? We need strong global growth and abundant global liquidity for emerging markets. Right. So the sweet spot of the cycle, we're not getting that. I'd say it's a 2024 story for EM. I'm a long-term EM bull, obviously, but it's a cyclical play. Right now, the cycle is working against EM.
Well, to your work out of Columbia and on to Brown Brothers Harriman, then, and currencies is the litmus paper, the indicator of all of this. Is the distinction here that you're stable dollar, or could you even surprise and say strong dollar?
I believe the sell-off in the dollar is a bit overdone. You were talking about the rate cuts being priced in. Right now, the market's still pricing in 3 rate cuts from the Fed by year end. I just don't think that's happening. Obviously, Mr. Powell does not believe that either. But markets are obviously trading on fear and panic. But in that regard, once those rate cuts are taken out of the market, which I believe they will be, then I think the dollar can get another leg up higher. And we've seen the expectations of the ECB and the Bank of England kind of come back. No more rate cuts priced for them, believe it or not. They were priced in last week. So again, it's as you mentioned, it's a very fluid situation. But I remain confident that the risks of a Fed cut in 2023 are really, really low. I really just can't make up, a story that can happen.
When I want to pick up on what you just said, that we're being driven by fear and panic, not by fundamentals. And the inflationary picture points to something that's very different for rate hikes or potential rate cuts as the market is pricing in. That said, a lot of people are talking about the natural credit tightening that emerges from some of these smaller banks losing deposits or having some funding pressures. How do you push back against that? That this basically accelerates some of the credit tightening, does the work for the Federal Reserve, and takes the pressure off them in order to get inflation under control faster?
No, Lisa, I think that's a perfectly valid point. In fact, Mr. Powell made that point during his press conference. Said a large majority of the FOMC committee thought that this would result in credit tightening that could lessen the need for further tightening. So obviously that is a distinct possibility. I think my only point is that it doesn't let the Fed totally off the hook. I think the U.S. economy remains pretty resilient. I think the consensus, your Bloomberg consensus for jobs is in March, I think 225K. Still, in normal times, that would be a stellar report. Obviously now it's kind of slowing from, very elevated levels. But, I do think that we'll also get the PCE and core PCE later this week. It just seems that inflation is much more stubborn. I've said this many times on this show before, is like, the easy part for the Fed is getting inflation from 8% down to 4%. The hard part and the painful part is getting from 4% to 2%. Right. And that's, we're sort of entering that era, that sort of period. And I think the Fed is pretty resolute. We're looking away, sort of beyond the banking sector. I think the central banks, to me, the big takeaway from last week from all the major central banks is, hey, listen, we're still tightening. We're a little cautious because of the unknown impact of the banking sector. We're still tightening. So they bought themselves some time. We don't have a ECB meeting until I think May 4th. FOMC is May 3rd. Bank of England is maybe a week later, I think. So they bought themselves some time. It's hard for me to see this banking crisis lasting, another month and a half. I think at that point, we may get the all clear to actually continue hiking.
When I want to take your holistic view here, and I want to bounce off the work of Dominic Constam at Mizuho right now, who was the first one I heard with the phrase super restrictive, which is not just calculations off the Bloomberg, but an entire macro structure of inflation flows, the LM curve, the IS curve, and such. How close are we to Constam super restrictive right now?
Well, that to me, policy, sort of the optimal policy rate is a moving target, and it's hard to pin down. We all talk about real rates. We've got nominal rates, somewhere just around 5%. But inflation is the moving target, inflation expectations. So to me, I don't think we're super restrictive yet. If you look at the Fed's, the Chicago Fed has a monetary conditions index, comes out weekly. It's starting to tighten a little bit, but we're still much looser than I think the Fed wants to be. This is, again, a moving target. Financial conditions will continue to tighten, but to me, if you look at the numbers and the economic numbers, financial condition numbers, we're nowhere near the sort of really, really restrictive. We are definitely approaching the restrictive territory, but is that enough to get inflation down, say, from 4% to 2%? That's the million-dollar question. And again, I don't envy the Fed. We already had the supply chain, the pandemic. Now they've got banking crisis sort of to worry about. But again, and by the way, thank you for using my quote. But I do firmly believe that it's really a regulatory failure more than a banking sector failure. And again, I'm going to draw this full circle. To me, low rates are the cause of these problems, not the savior.
Yeah.
Cutting rates back to zero is absolutely the wrong thing to do. It's just going to add to the excessive risk taking, et cetera, et cetera. So unfortunately, I think we're going to have to kind of sort of, really grit our teeth and get through this. And I think we will. I think banking sectors are resilient. I think we can do the job here.
Very few people are talking about rates going back to 0%. And I think that really is the crux of the question, right? Where do we end up? I do want to, though, speak to your expertise on this holistic kind of cross current of the world and going to China and the supposed boom that we were going to get from China's reopening, this idea that was going to spur even potentially more growth, if not disinflation, because of the production that would come back online. It hasn't been such an optimistic story because growth has underperformed. How does that play into your expectations of the ongoing momentum if we don't have that China impulse coming through to the degree that people thought?
Well, I think the silver lining behind that cloud is that the sort of disinflation forces will remain intact, right? Because there's always the fear China comes online, all of a sudden copper prices surge, oil prices surge, but you see, I think the opposite has happened in the last couple of weeks, and partially obviously due to the banking crisis, but we have had a series of soft data readings out of China. So I think in net, yes, it's obviously negative for global growth, but the good news, again, the silver lining is that maybe that we get these disinflationary forces will continue.
Yeah.
But again, I just don't think the markets can count on China to be the savior of global growth this year. It's just, it's much more domestic, inward looking. It's really trying to become much more self-sufficient, not sort of keyed into the whole global export chain and all that, et cetera, et cetera. So I think the other countries are right in trying to find alternative supply chains. We know that Mexico is going to benefit from some other regional economies.
Win Thin, thank you so much for joining us. Dr. Thin is with Brown Brothers Harriman there with a global and holistic view of really a financial system in crisis on this movement in rates. We've been remiss. We're at 6:39 in the morning right now. And Lisa, we really haven't done the scorecard on the good Monday news of regional banking in America. It obviously leads to the poster child, First Republic, up large, up 25% at one point, basically a 12 to 16 move on First Republic. And a single sentence, which I think over the weekend was missed by many, First Citizens, they're going to buy SVB. So there is action here in a Yellen-friendly way, is how I would put it this morning.
Well, they finally completed a sale. It was clear that there was some concern over why the FDIC delayed it. Was there just no bidder? There was clearly a bidder, so that I think definitely gave people confidence. There also, though, was a feeling that there was a little bit more transparency, perhaps, around the idea that First Republic could exist for a longer period of time. This is what regulators came out. I will say Deutsche Bank shares also rebounding after being lower and under pressure last week, up about 5%. Over in Germany, how much of this is a larger issue of people just saying, okay, maybe we threw the baby out with the bathwater and weren't trading more on, to Wynn's point, fear rather than fundamentals? In my call with
Steve Aarons this morning in Frankfurt, we spent half the call on cultural differences between Germany and Switzerland, and for that matter, the individualistic United States where it's every depositor for themselves. I think that was the phrase that was used by Franklin. But the basic idea here is these are hugely cultural, and Steve Aarons emphasized to me that German people, is a general statement, stay put with their loyalty and their deposit.
There's less deposit flight risk generally in Europe based on the structure of certain investments. Yeah. At that same time, Deutsche Bank has done a lot to get itself into regulatory shape. I mean, it's basically a different profile than it was, 10 years ago.
I just figured it out. Oh, God. Dr. O'Larian, thank you so much for bringing this to my attention. The coach of the Tots was canned, and Pharaoh's not in.
Correlation?
I think it's correlation. Yeah. I don't know.
Or causation. Is he going to be the next coach? You think so?
Bloomberg Surveillance, good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Silicon Valley Bank branches will open under a new name today. The FDIC says First Citizens Bancshares has agreed to buy the failed lender more than 2 weeks after its collapse. The North Carolina-based firm will purchase all of their deposits and about $72 billion of SVB's loans at a discount of $16.5 billion. Now, some $90 billion in securities will remain in receivership. Credit Suisse faces the threat of a possible investigation and disciplinary action over how top managers ran the bank in the lead-up to its collapse. Switzerland's banking regulator told a Swiss newspaper that officials are considering options. She says Credit Suisse had a cultural problem that led to a lack of accountability. The UK's independent public spending forecaster says the country's economy is 4% smaller because of Brexit. The chairman of the Office for Budget Responsibility, Richard Hughes, told the BBC that was similar to the impact caused by the coronavirus pandemic. The UK is the only developed economy not to have recovered to pre-COVID levels of GDP growth. China's economic recovery was mixed in March. Business confidence and the housing market improved. But according to Bloomberg's latest index of 8 early indicators, falling car sales and weak global demand drags on the economy. And Salesforce has reached an agreement with activist investor Elliott Investment Management, which will not go ahead with a plan to nominate directors. Elliott's multi-billion stake in the software maker became public in January, and it put forward a slate of directors. Salesforce has been under pressure as revenue growth has slowed. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. And then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
The aerospace engineer from Minneapolis, Neil Kashkari, Fed president for Minneapolis there, driving the story forward. Lisa, help me here quickly with speakers today. Schnabel of Germany, Bailey of England, and then
Jefferson, Fed governor, back in the end of the day.
And let me guess, 14 more tomorrow.
We get a lot of speakers and very little clarity because I don't really understand what they could possibly say that might give us a better sense of what they're going to do.
Again, if you're just joining us here on radio and television, it's simple. American banks up today. I think we can state that with futures up 23. Even Bitcoin up fractionally, rounded up to 28,000. 2-10 spread disinverts. It comes in a little bit. I've even got $70 West Texas Intermediate crisis over.
There's a lot of signs that there's a bit of calming. It'll take more than one day as people take a look at, potential other jitters. But that said, there is definitely a feeling of calm.
Somebody noticed my cough. Yeah, I have a little bit of the plague. We were on a cruise. And it was a 3-island tour. Ginger gave me, it's not COVID, but Ginger gave me, something.
Ginger on the cruise? Did you do the Macarena?
No, I did not do. No, Gilligan did the Macarena. Joining us now, and this is really important and timely because it has been removed from the banking crisis, removed from our world, but it's not. It is France and Israel. Tina Fordham joins us now, founder, geopolitical strategist, Fordham Global Foresight. Tina, I have been dying to talk to you about this. I understand in France, and I want to get to that in a minute, the Sixth Republic and what Mr. Macron's going to do. But the images from Israel over the weekend were stunning. I interpolated the extrapolation. Tina, it's as if 22 million people were protesting in America. Who are these people, Tina Fordham?
Thanks, Tom. And I wish I could hear more about Gilligan's Island and if the professor and Marianne were there too. I like the beard. Yes, big protests over the weekend. We're back to a period of Vox Populi risk, flames. My outlook this year is called firewalking. But as you say, markets have been very much focused on the crises in the banking sector, what it means for Fed policy. And the reason to take a look at these protests from a financial markets standpoint is whether or not there are transmission mechanisms and what's behind them. And I think one of the things that market participants tend to not be very good at is understanding the root causes and the interlinkages between these things. So you ask, who are the protesters in Israel, a tiny country in which a huge proportion of the population is not only protesting, but going on a national strike today in light of what is called a judicial coup. Bibi Netanyahu's proposed reforms amount to the executive branch of government neutralizing the judiciary, as if Congress could overtake the Supreme Court. You have like with all big protests, you've got segments of the Israeli population coming together. If it was one group, then it would be a flash in the pan. The staying power here is that secular Israelis, as well as the defense sort of reservists, as well as the defense minister himself, who was sacked last night, urban types, let's say, the tech sector, which is the driver of the Israeli tiger economy, are coming together to say, no, this is anti-democratic. And so it is really quite existential for a country that is often referred to as the only true democracy in the Middle East. And we haven't thought about Israel for quite a long time.
Well, there's the point, Tina. And my demarcation of my life is not Sadat and the rest. It is the assassination of Rabin in 1995. That is my demarcation between the old Israel of our childhoods and the new Israel. Are we at another demarcation point like we were with that assassination 30-some years ago?
I think so, unless Netanyahu and his supporters do more than pause, which is the easiest thing to do, and actually climb down. I don't think Israeli society is going to tolerate these so-called reforms. People have fought too hard, and the state of Israel means too much.
We've been seeing not only protests in Israel, but also in France, and of a different nature. They're sort of more populist in nature, but there feels like there are these fissures that are emerging in some of the stalwart democracies of the world as people try to understand the correct path forward, whether it's what's going on in Israel and undermining the judiciary, or if it's in France, where people are protesting the increase in the retirement age and wages. How much do you see this percolating into something larger that perhaps could affect markets, that could affect what we understand in terms of alliances, as well as just the wage pressures that are emerging?
It's a really important question, Lisa. And the French protests, I mean, you know, the sort of American stereotype was always the French don't want to work. Raising the retirement age from 62 to 64 is something that Emmanuel Macron campaigned upon because, as we all know, we are living in graying and kind of shrinking economies where there aren't enough workers in the demographic pyramid. But it isn't just the sort of the requirement to work longer that's getting the French out in the streets. If we want to try to connect it to this wider kind of Vox Populi resurgence, it's also the fact that Macron is resented for being perceived to ram this change through and to do it without wider support in the French Parliament. What is at stake here is, in my view, if we kind of link it back to the wobble that we had here in the UK, which wasn't about protests, but also involved the pension sector, is the extent to which taking away fundamental rights or a public perception that that's happening, particularly when it comes to pensions, is an electrified third rail. And so with that in mind, I take issue a bit with your previous speaker, although I know what he meant when he said markets are reacting with fear and panic and not fundamentals. Pensions and constitutional rights are fundamentals. They're political fundamentals. Our task is try to understand when they feed into markets.
Tina Fordham of Fordham Global Foresight, thank you so much for being with us. It's an important moment, especially given all of the tensions that we see. And it's not just what we're seeing with respect to traditional democracies and the interconnectedness of, kind of what we've seen in the wage pressures to some of the fissures that we've seen in traditional democracies. But there's this sort of existential overhang of what's been going on with Ukraine as well.
Yeah, what's so important here, and this is really, really something we're going to focus on here through the summer. We're, of course, attending Washington, the meetings of the World Bank and the International Monetary Fund, all sorts of good plans for that with good people. But I don't want to over-civics this. I don't want to go, full Richard Haas, to Ambassador Haas. We don't want to go full Richard Haas here, but the linkages are there. For example, in France, and this is with John Fenby's great work over the years, the Fifth Republic in 1958. I was in Paris in '68 when de Gaulle started really falling apart, when it began to fall to pieces, and they picked up the pieces. And so people like Tina Fordham are talking about the revolution of a Sixth Republic, or they're talking about, is this going to be a sea change if Netanyahu doesn't back down? And to me, it all links in to the tensions of the financial system, the Chris Whalen financial system, moving from low rates out to this new regime that we used to know years ago.
Well, and I think that we're shifting from a regime of low inflation into one of higher inflation. That's what a lot of people have said.
More persistent, with Adam Posen coming up today, yeah.
So at what point does that pressure some of the traditional oversight, the traditional sort of democratic structures of nations that were governed and sort of on autopilot a little bit more for those years of a more stasis kind of economic backdrop? I mean, you think about wage pressures. We're seeing this even in the UK. We've been talking about that. That used to be an area where you did not see strikes like you saw in France, and now you are seeing strikes like you used to see more traditionally in France. Right. How much is this really a result of people really feeling the erosion of their spending power in an era of incredibly high inflation and making demands that they just haven't made with a certain, just visceral angst?
Distant past, if we'd gone to Davos, I was going to call it something like the Davos zombie roll-up. But my theme for the year, and I stand with this, is 2023, the Great Zombie Roll-Up. And I didn't see any of this coming, including the international relation events. This is ongoing. At least I'm in the camp. It's not going away, even if we do solve the American banking crisis.
I think a lot of people would agree, and that's what we're seeing right now with the reason why there's all of the volatility is people price out the unknown.
Pharaoh, before he left on a three-day island cruise, a three-island, three-day cruise, put together a great set of guests for you. Mike Wilson of Morgan Stanley soon. This is Bloomberg.
Most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky, he's a good guy. You know, he has mercy. The other one has no mercy.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Inflation's coming down, but we don't think it's going to come down quite as fast as markets are pricing in.
I think inflation's really dying out quick right now, but I think it's probably got another leg up.
I don't think we've licked the inflation problem, and so that's why we're not anticipating that the Fed's going to cut rates.
They are still fighting inflation. They are still dealing with their core mandate.
If we listen to Chair Powell, effectively he was saying, we can't really give you forward guidance at the moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Monday after an historic week. I wasn't here. John Farrow's not here today. He is on a serious assignment here for 3 days. You know, we'll see. I think it's, you know, looking into my new beard and all that. People are saying, should I keep the beard? And on radio, it's a thoughtful process. You're lucky you're on radio. But it's Lisa and I here on a day after crisis with all your work, Lisa, last week with John, which was, I heard all around the world the anecdotes about what you two were doing, the special broadcast on Sunday, the Fed show, the exhausting week that it was. Why should it continue this week? I mean, are you in for another week of this, or do you pause?
I think everyone's a little tired. And by the way, you were missed. I think that right now, what we're looking at is an exhaustion taking over a market with no new information. I mean, basically, the fact that there was no new information is information. It's basically telling you the fact that there hasn't been another failure, there hasn't been another rumor, there hasn't been another weak link that's been pointed out is a fantastic sign, and people are rallying behind that, and you can see that in markets
They're
today.
rallying in the equity markets as well. SPX futures up 0.6%. NASDAQ lags a little. We'll see where that juggernaut goes. The VIX 21.68. And of course, the lift here is in the banking stocks, which I think says all. First Republic Bank has been a challenge as well, lifting nicely from a 12 level up to 16 with a lot of other 3 and 4% moves. Is it all clear for Secretary Yellen? I'm not there.
Well, there was an article that I read over the weekend that I loved that really highlighted how they don't want to overpromise measures that are going to be deemed unnecessary after this wave of panic ends, but they want to create just this feeling of support for banks. So how do they toe that line when they're not proposing policies? They don't know what they don't know, right? They don't know how far this can go. And that was the confusion of last week. If we don't get any more failures, are we in the all clear? To your point, do we get the sense that we don't need to really focus on Janet Yellen anymore for a possible emergency rescue or bail-in or whatever you want to call it? And if that's the case, it gives people a feeling of stability underpinned by this idea that we've still seen hot inflation data and hot and robust economic data.
I mean, I'm going to look, Lisa, at the BTMM screen as we discussed in the last hour, and I thought Jim Bianco's comment here, I don't know, Chart Banner, if you've got it in the control room, but Mr. Bianco, with my short tweet of the weekend, it wasn't like one of his 6-page opuses. It's like Exodus in the Old Testament when Jim Bianco writes, and this was just simple. It's a 5% world. It's just that simple. It's 5% world.
But for how long? And this, just to go for what happened last week that still has remained in the market, you take a look at what rates are expected to be in January of 2024, less than 4%. So that is more than a percentage point of rate cuts from May through January of next year that's being priced into markets regardless of the stability that people are seeing in the banking system.
We're going to truncate the data check. We've got an important guest to start this 7 o'clock hour strong on radio. On television, 2-year yield 3.93%. We're still under 4%, but that's constructive. A lot of constructive tone out there with disinversion still under play. The real yield 1.21%. Again, I'm going to go to SPX up 24. Lisa, what's your world look like? What does the spread market look like over the weekend and to start?
What you've seen is really spread widening, particularly in the riskier credit. There is a feeling that perhaps you've got to price in more default risk when it comes to high yield bonds, but otherwise, it's calm. That calm is what people are pointing to for a reason to support some of the construction. Just want to give you a sense of what we're watching today.
Please.
At 11 a.m., we hear from ECB Executive Board Member Isabel Schnabel. She's going to be speaking at Columbia University at 1 p.m. Bank of England Governor Andrew Bailey. He is speaking at LSE, at London School of Economics. 1 p.m., an auction of the notes that have traded, as John said, like penny stocks, $42 billion of 2-year notes at a time when you've seen a roller coaster unheard of in modern history in terms of suddenly pricing out any further rate hikes and even rate cuts through year end. And at 5 p.m., we hear from Fed Governor Philip Jefferson talking about the transmission and implementation of monetary policy at Washington and Lee University. Does monetary policy matter less when the banking stresses do it for you? That is the question facing so many people at this moment.
Michael Wilson joins us now. He's Chief U.S. Equity Strategist and CIO at Morgan Stanley. Of course, many of you on Global Wall Street hang on every word if you agree or disagree. Mike, I see a massive polarity in the equity markets right now. It's a select group of haves and everybody else dragging along looking for the next narrative. Am I right on that polarity?
Yeah, that's right, Tom. I mean, you guys were talking about the bond market's volatility here recently. We've been focused on that too. We think that, the bond market is sort of jumping ahead of what the Fed is saying. And that's the first time we've really seen that in quite a while, meaning that the bond market is somewhat, dismissing the Fed's dot plot, which I find interesting because I think the equity market may start to do that too. And it's already happening under the surface, as you alluded to, meaning small cap stocks and anything that's sort of viewed as lower quality or will have challenges with needs capital availability is being punished. And then we're left with, 20 stocks kind of carrying the day.
I mean, the 20 stocks carrying today screams the roll-up I've been talking about for 6, 7, 8 months with the interest rate regime that you studied at Michigan a few years back. With that said, is it a return to what you and I knew years ago, or is this a new higher interest rate regime for the stock market?
Well, I think it's a little bit of both. I think what it really is it's just a much less predictable world. And this has been our theme for the last couple of years, is that we're entering a period of higher economic volatility, right? The last 20 years has been a world of repression where, all of these metrics were somewhat predictable. And that's for companies, that's for the Fed itself, that's for investors. And now we're entering a world where it's just not as predictable. And that means higher risk premiums, whether we're talking about credit, whether we're talking about term premium in the bond market, or we're talking about equity risk premium. In our view, I think people are operating as if we're going to go back to that predictable world, and that's, I think, misplaced.
A lot of people have been reading your prognostications of lower earning multiples for week after week after week. The latest from you, given the events of the past few weeks, we think guidance is looking more and more unrealistic, and equity markets are at greater risk of pricing in much lower estimates ahead of any hard data changes. Mike, given that you've been saying this for a while, and given the fact that we have continued to see resilience in equities that refuse to go down, how do you push back and say, you guys are going to wake up? It might not be yet, even if we get disappointing earnings, but you will.
Well, look, we try to navigate that inside the equity market, right? So, last year we saw a pretty big degradation in multiples, but as we pointed out again today, all of that was due to higher interest rates. None of it was due to higher risk premium, which is the part of the multiple that is, pricing in what growth is going to be. Now, I would push back on the pushback, which is that the market is starting to revalue or devalue what I would say the companies that are most at risk of missing estimates. As I mentioned earlier, lower quality companies, more cyclical companies, smaller cap companies that are going to have a hard time with what's going on in the regional banking system. So it is happening. It's just it takes a little bit longer, and everybody kind of focuses on the S&P 500 or maybe NASDAQ 100 as these kind of bastions of safety, and that's true until it's not.
Well, okay, so let's talk about the repricing. Last year we were talking about big tech, and this year the repricing has been in the opposite direction. I'm looking right now at Meta, Facebook, shares up more than 71% so far year to date. Apple shares up more than 20%. Basically, pick your poison, and it's up dramatically. How do you push back against this, against the recovery of some of the names that supposedly were going to come under pressure in a higher rate world?
Well, I think you said it right. These companies took their punishment last year because they were, probably the tip of the spear in terms of, valuations out of bounds. So when rates went up, they took it first. And you could argue that a lot of those groups or, stocks and sectors that they're in are in a recession already, right? That's the area we are seeing layoffs. That's the area we are seeing retrenchment on costs. And I think the debate now, Lisa, is, have those companies cut costs and gotten in front of it enough where they can now see earnings growth again? I think there's some appetite for that view. That's not our view. Our view is that there's going to probably be more cost cutting in that space because the malinvestment was just so egregious and the over-earning was even worse. So I think it's just going to be kind of a drip, drip, drip. My suspicion is markets tend to figure this out ahead of the actual numbers coming down. And because the bond market just repriced itself overnight, we think that risk for the equity market is elevated now more than it's been for the last 6 or 12 months.
Mike, you've been labeled a bear, and I know what it is to be labeled a bear, and then people think that everything that you say is bearish no matter what. I'm just saying, even when potentially you do get constructive, are there any areas that you think have sufficiently repriced where you're starting to see opportunity?
Well, look, financials have started to reprice in a meaningful way. Not all of these companies are going to have problems, that we're seeing in some of these. So, yeah, I think it's happening. The other thing I would just point out is that, financials tend to lead the overall market, but that's one area for sure. Some of the retail, some of the consumer areas have repriced. They've been repricing for years. We just added a name to our fresh money buy list as a retailer. So, I think there are definitely areas. Markets go through these periods with, I call it a rolling bear market, rolling recession. We've kind of, I think, came out with that view a few years ago. Now people have used it, but that's the way it works. And we're looking for opportunities now at the stock level, But at the index level, it just does not look attractive to us.
Mike Wilson, the thing that's different this time around is the pile of money in what's called private equity, private markets. Can they be a catalyst for not like Milken years ago, but can they be a catalyst for a roll-up of all these troubled companies?
Well, look, I mean, first of all, I don't think there's that many, troubled companies. I think we have a situation where valuations are out of bounds, and we need to correct that. I absolutely think there's tons of cash out there where there's private or public money, public money, meaning asset owners that can come in at the right price, and it will. So whatever we're going to get here in the next 3 to 6 months in terms of finally resetting the valuation appropriately, getting estimates down, I don't think we're going to stay at very, very low price levels for a very long time. We're not in the camp that we're in a secular structural bear market. This is a cyclical bear market. It has some completion to it. And your question is really around, is there enough cash and investable funds out there to kind of, stabilize things? And I think the answer is absolutely yes.
Okay, Mike Wilson, thank you for the brief this morning. Hugely valuable. He is, of course, with Morgan Stanley. I thought you were vulnerable. I thought Dr. Wilson provided wonderful Monday therapy.
Thank you. I try to get it everywhere I can. No, I think it's important to note he's not looking for some sort of structural bear market, and the opportunities potentially in banks, I think, is fascinating that he was highlighting.
This will be a discussion to continue, and we will do that. Stay with us. This is Bloomberg Surveillance on radio, on television.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The failed Silicon Valley Bank has a new owner. North Carolina-based First Citizens Bank shares will buy about $72 billion of SVB's assets at a discount of $16.5 billion. Now, as part of the deal, the FDIC will get stock appreciation rights in First Citizens worth up to $500 million. Authorities took extraordinary measures to shore up confidence in the financial system after Silicon Valley Bank collapsed. The head of Credit Suisse's largest shareholder has resigned after his comments helped spark a slump in the bank's shares. Ammar al-Qudairy was chairman of Saudi National Bank. His remarks came in an interview March 15th with Bloomberg's Yusuf Kamel Al-Din.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
Saudi National Bank says al-Qudairy is leaving due to personal reasons. Twitter is looking for whoever leaked parts of its proprietary source code. That code was posted on GitHub, the widely used code repository that's now owned by Microsoft. GitHub complied with Twitter's request to remove the data, but Twitter now wanted to identify anyone who posted, downloaded, or uploaded its code. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Look, I think we've done a pretty damn good job. People's savings are secure, and even those beyond the $250,000, the FDIC is guaranteeing them that the American taxpayer is not going to have to pay a penny. The banks are in pretty good shape. What's going on in Europe isn't a direct consequence of what's happening in the United States.
In pretty good shape as well. The President of the United States, of course, speaking on a banking crisis. I think, Lisa, we've had 4 once-in-a-lifetime crises here since 2007. John Farrow at the Crisis is on assignment here for 3 days. Wishing him safe travels. And it's Lisa Bramlett and Tom Keene on Bank Recovery Monday. I guess that's what it is. I mean, the fact is, Chris Whalen tweeting out about First Citizens putting somebody out of their misery. There's a set of good news here for Secretary Yellen.
And the absence of bad news. And I think that's important because what really spooked the market was a sense of a series of steps that, really seemed to be linked together, even if they weren't. And that was what gave rise to this narrative of some larger concern.
The narratives to get the 2-year yield to 4%. We're not there, 3.95%. The narratives to get oil above 70. It is $68, $69. West Texas Intermediate is now 70.18, and S&P futures up 0.7%. I thought the discussion with Tina Fordham was stunning. It was chilling. It was like literally back to my ute.
Well, there are a lot of people who are concerned about the weakening of judicial power in Israel and then the firing of the one judiciary who stood up to Netanyahu. And that is what happened. And that's what caused the eruption of these protests with real concern over the stability of the democracy going forward. And that, I think, is really underpinning what is driving so much attention to this.
We're going to get to the bank crisis chat in Washington. Anne Marie Horton is, of course, encyclopedic on it, but always so well read in on the international relations of the moment. I was thunderstruck, Anne Marie, in talking to Tina Fordham about the allusions here of France and particularly Israel, back to my ute, of Sadat, the assassination of Rabin. Help us with Jews in America, and particularly conservative, more Orthodox Jews in America, which Pew Research of New Jersey says, you know what, these people are very Republican. Help us with the lobby dynamics you're going to observe on this tumultuous Monday in Washington.
Well, I think it puts a lot of people in difficult positions, right? Because what you see in Israel is a huge backlash against what Prime Minister Benjamin Netanyahu wants to do. Even President Herzog has come out and said we should take a pause. I mean, there's been protests, though, we should note, over the past weeks, really months, about this judicial overhaul. But as Lisa mentioned, it came to an absolute point of just overflowing outrage when, while in London, actually, he sat down for an interview with Piers Morgan, Netanyahu, that'll air this evening, that'll be interesting given this moment, fired his defense chief. And now there's a lot of havoc in the country. I mean, you see the Tel Aviv airport is broken up. But obviously, Israeli politics, Tom, to your point, matters a lot with Jewish Americans and constituencies here, which we have seen lean Republican, especially during the Trump administration, but potentially with what's going on in Israel, this is not something that Jews in America want to wake up to and see on their television screens.
The enormity of this, folks, for those on radio, the imagery that we saw, Lisa Abramowitz, 600,000 plus was one estimate of the protests just yesterday. I mean, remember the protests in Brazil? Like 3-4 years, it was that magnitude of streets full as well. I mean, I guess that's enough on Israel, and we didn't even get to France there, but there's still a lot of banking issues going on in the modern world.
Well, and that's where the focus is, probably more than the geopolitics, and it has been, and we do know that there are going to be hearings coming up, I believe, on Wednesday, Anne Marie. What are we going to glean from them? And I know a lot of people would say nothing. They're just hearings, they're grandstanding, they're talking about, we are mad, something bad happened. But I am wondering whether it gives any indication of the willingness to create a different regulatory structure or deposit insurance or some of the other things that people were talking about last week.
Well, you got the ethos and tone of what the hearing is going to be, Lisa, which is definitely that lawmakers are going to be very upset that something broke, right, in the financial system, and they want to point the finger who was responsible. So Wednesday, when you have these regulators like the FDIC chairman and also the vice chair for supervision at the Fed, Michael Barr, show up to the House Financial Services, there's going to be very pointed questions about what went wrong, who should have been supervising this? Was it the hands potentially of a lack of oversight at the Fed in Washington, or is this about the supervision at the San Francisco Fed? And then obviously you're going to try to also potentially garner some more questions and concerns about the state of the economy. Are there more underlying risks to other banks because you have the Fed hiking interest rates so aggressively? And then potentially a discussion about the FDIC cap, which is what the hands of lawmakers can actually change.
Yeah.
And I think this got to the tension of last week with Secretary Yellen talking about a blanket change. That would have to be, when you look at the insurance cap, that would have to be in the realm of Congress, not something the Treasury Secretary can come out and do.
But these hearings are probably a non-issue because there's very little willingness to do that, right? There's very little willingness to be labeled as some sort of bailout friend of some of the banks, whether they're big or small, and that's really going to loom over everything. So why is Washington, D.C. having hearing after hearing on things that they're not going to take action on when they actually have to take action on a budget and other things in Congress before their recess?
Well, this is another good point. There's also the debt ceiling that is still circulating. When you talked about the budget, we're still waiting on the Republicans to have their budget proposal, but we also know that behind the scenes, they're working on a deal sheet, basically what they can go to the White House with and say, these are our demands in terms of fiscal spending cuts in order to get our votes to raise the debt ceiling. But of course there's going to be hearings because they do need to find out and look into. I mean, the senators and congressmen and women that I speak to say they do want a full autopsy. And potentially you've heard some of them talk about lifting the FDIC cap. That could be something that happens, but it won't happen right away. This is not going to happen in days and weeks or months, as you mentioned.
Amory, totally unfair question to end things out, but I'm going to go with it. On this Monday, with bank stocks doing better, I mean, there's a set of good news here after the trauma of last week. Is there anybody in Washington moving on from this crisis, as Lisa alluded to earlier?
Moving on? No, I don't think anyone is moving on. There's going to be hearings this week. On Friday morning, we found out about this unscheduled meeting of regulators. Behind the scenes, you do know that officials are still looking at what's going on with First Republic. Do they need to extend a lending program at the Fed to help out that bank? No one is moving on just yet, even though the president has said over the weekend he thought they did a, quote, damn good job.
Amory Horton, thank you so much. Our Chief Washington correspondent, of course, with a modest program in the afternoon. What's it called? Balance of Power. Balance of Power. Thank you so much, Amory Horton. With Joe Matthew, I should point out. Futures up 29, Dow futures up 219, NASDAQ up 0.5%, is all 21.47 on the VIX. What an odd Monday in that it's all clear Monday, but as Anne-Marie just said, no, it's not.
Well, there's still angst out there, and there's still a feeling of the next shoe to drop. I mean, Mike Wilson talking about the potential for earnings pressure in a substantial way, and this to me is the unknown. This to me is the lack of immediate histrionics, but longer-term pain that people are trying to wrap their heads around. This idea of what happens if credit conditions tighten materially, what happens if the lag effects are more material than people had previously thought, and all of a sudden you start to feel them in a much more significant way.
And the other thing is the surprises out there looking at the unmovable story, which is the BTMM screen on the Bloomberg, which shows me higher yields, which really haven't budged yet. I mean, to see a given 5% statistic go to 4.90.
Correct.
I really don't believe I've observed that. I looked at some mumbo jumbo that only Higher Jersey understands, and it legged up Friday.
Well, okay.
I mean, that's a fact.
So I'm looking right now at 6-month T-bill yields. We talked about how they went north of 5%, and this was a huge threshold moment because suddenly you go into money market funds and get more than 5%. Those yields have come down, and perhaps to your point, because of the floods of cash into money markets as people tried to take advantage of these rates and gain that safety, now they're at 4.68%. That's still 4.7%. People used to get nothing on their cash. So you can think that that's still a lure. The problem hasn't gone away for the banks that are trying to attract
these
deposits.
The information. Let's be clear. Over the weekend, Friday maybe, we saw deposit flows. But they were deposit flow statistics from a long time ago, like 10 days ago.
Exactly.
And I'm fascinated to see what the next tranche of flow data shows us. I'm going to suggest mom and pop are moving their money.
And they're moving the money into money markets, not necessarily even to larger banks or even, within a certain bank. That's basically more of the issue.
I mean, it's for just full disclosure, folks, I really can't comment on the niceties of the triple leveraged all cash fund, but it's never been like it's been.
You've been just rocking
we may get our first 2 and 20 payout from the fund because of flows in like 5 years.
I hear ChatGPT is really excited for its 2 and 20 payout.
It is. Well, we're looking at that ETF again, but again, this is the 5% world that has changed all. What has changed is, again, green on the screen, the equity shock of this March. This is Bloomberg Surveillance.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrell, Lisa Bramwitz, and Tom King. John Farrell on assignment here over the next number of days. I do think it's a three-island tour. We'll see when he returns. Lots going on this morning, and if you're just waking up into this on radio and television, it is an American recovery in the presence of this banking crisis. We just heard the president commenting here on the better news. Futures up 30, Dow futures up a solid 230. Over 4,000 on the Standard & Poor's 500 500. I don't think that's a small issue. Mike Wilson talking about the resiliency of a few, the VIX 21.45, yield 3.94, migrating towards 4%. We're not there yet. 210's giving me disinversion, and oil critically above $70. West Texas Intermediate, $70.11 a barrel. It is a summation of good news for banking, and you see it pre-market. Moving with the movers, Lisa Abramowitz.
Yeah, we're looking at some of the mid-sized banks. It is important to note that, yes, we are seeing gains today with First Republic shares up almost 30%. Wow, that sounds like a lot. They are down almost 90% since March 8th. So just to give you a sense, when we start talking $15.81 a share based on where we have come from, it's a very different kind of scenario. They were as high as $147 a share as recently as February. You could take a look at PacWest. Those shares lower by more than 60% since that March 8th moment, but you are seeing a bit of a rebound, up about 11%. Western Alliance, similar story. Deutsche Bank is a more interesting story to me on some levels because it is sort of speaking to this question around systemic risk. Deutsche Bank came under a lot of pressure. A lot of people came out and fought that, said, you know what? It's not right. They actually don't have the same kind of regulatory pressures. Stop throwing the baby out with the bathwater. That's what we heard from Mike Wilson, not about Deutsche Bank, but just in general about financials, that it's looking a little more interesting. So how much are people able to quantify how much you can earn in a 5% world as a bank if you're not worried about some funding pressures that seem to have stabilized?
I was in the harbor packing away the grand banks, and I did a survey, Lisa, of nine newspapers. Deutsche Bank wasn't a story this weekend. And based on what I read Thursday and Friday, I mean, I'm sitting at a cabana with Stuart, and it's a whole bunch of bankers having rum punches, and everybody's wired in on the phone to Bloomberg and Frankfurt going, is this Credit Suisse? And the answer, I believe, is no. And then the story just evaporated.
Exactly. And so, you know, the whys, et cetera, people could do an autopsy of strange market moves and what people misunderstood or what games people were playing. But you are still seeing elevated credit default swap insurance protection. So again, I don't know if there are games being played. Have the concerns abated or have they just subsided for the moment as people reassess and wait for what's next?
Quickly, unfair question to you. Do we look for announcements this morning or even through the day from government officials on this banking crisis?
Not right now. It's not really required because right now you're not necessarily seeing that urgency. Emory did talk about what we heard on Friday from the FSOC meeting, the Financial Stability meeting, and Janet Yellen was there, and Jay Powell was there, and Tim Geithner was there, and they were trying to assess what happened. They're on it, right? They don't want to have egg on their face with another. We need to raise 50 basis points, and then, oh yeah, First Republic just went under.
Yeah, there we are. Futures up 31 and climbing this morning, up 0.8% on S&P futures. We need a brief, and we get it right now for someone who's wonderfully holistic here. Her iconic work on foreign exchange over the years. She's chief U.S. economist, FS Investments. Laura Rahm joins us right now. Laura, I've been dying to ask you this question off your research note. You go right to the confidence of Americans. Is it a confidence of one America, two Americas, or dare I say even three Americas? How do you study our confidence in crisis?
I think right now, none of the confidence measures are back to where they were pre-COVID. For as strong as the economy is, confidence has been very tempered throughout the last year. And right now, to your point, depending on where you look, it does look more fragile. But I think we are going to really see the direction things are moving in over the next month. It's actually the one piece of data this week that I think is really important and could be telling, the consumer confidence data. And I think when we look for, the talk of recession is in the air again. It's, the volume's been turned back up to 11 on that. But if you look at the underlying macro data, it's still really strong, and confidence could be the weak link there.
Excuse me, I'm gasping here over the plague in the Caribbean. Laura, I want to talk about this disconnect between interview after interview stating the slowdown of America and the statistics I see. What is your GDP call for this ending first quarter?
It's over 3%. And I think
Lisa, it's a crisis.
It's really strong. Labor market, really strong. I just want to roll my eyes when I hear people talking about cracks in the economy, because you got to take out a microscope to really find any sign of significant slowing. And so, can we maintain this? Probably not. But do we slow to something? I have been expecting some kind of slowdown. I don't think that's a bold call. The Fed is aggressively raising rates. At some point, they do usually push the economy into a period of deep slowness, if not contraction. But my outlook has always been for the end of 2023. I think the question we ask now is, have the banking-related uncertainties, is that going to pull some kind of mild recession forward? But this is the problem for the Fed. They are not out of the woods. They are still stuck with this really difficult policy fork in the road. Because if you look at the data in and of themselves, continued rate hikes are a no-brainer. And I feel like in their statement, they tried to minimize the banking systemic issue. And they tried to just look at the data, and they're trying to pivot, but it's hard.
Lisa, the Consumer Board consumer confidence number from a 102.9 is going to crater to a 101. I mean, that speaks of a 3% GDP number we're talking about.
And we've seen better than expected services activity over in Europe and in the U.S. again and again and again. Laura, then how do you push back against a market that's seeing rate cuts of almost 100 basis points through next January? How much are they wrong in your view? How much is the next stop perhaps 5.25%, 5.5% before we see rate cuts?
I push back really hard against the rate cut expectation. I think we will see that temper over the coming several months. The cutting of 100 basis points to me is more of an indication of a chance that we're going to hit some systemic banking, need to go back to ZIRP. That's the probability. It's not just 100 basis points of rate cuts. But at the end of the day, if the Fed really sees a recession coming, they're going to do something. I just think the timing of all of that plays out much later. When you think about the Fed and all of these, they've still got a big inflation problem. And I think for them, they are really trying to separate the banking from the economy. One thing I was disappointed about is they didn't adjust quantitative tightening. I think lost in all of this is the fact that cash reserves as a share of bank assets for the big banks is really high, but for the small banks, it's pretty low. We're down to 6%. I think QT should be winding down at this point, but we'll see what they do as they kind of look back and reassess these banking measures, because you can't kind of give the banking system money on the one hand and then be taking it away on the other hand. I think that was a miss.
And probably a lot of people would glean a little bit of honesty from them if they see the balance sheet going up, and at the same time they're saying no, QT is still full board ahead. So there's a question about messaging there. Laura, from your point of view, then, do you think that as we've seen so far, if we don't see any more bank failures, that the credit tightening from banks will not be sufficient to really do the work for the Fed to the degree that markets think? How do you basically extrapolate that out in kind of an absence of information that people are worried about?
I think we will get information. I think that a lot of the banks will be talking more about their lending standards. It's hard to imagine coming out of this with looser lending standards. They're going to tighten somewhat. But we have seen one of the reasons the Fed has had to raise rates so aggressively is because our economy is less interest rate sensitive than it has been during prior episodes. When everybody had interest-only mortgages, it didn't take as many rate hikes to slow us down, and we still had to raise rates to over 5%, and that was without an inflation problem.
Laura, we're running out of time, Laura, and you've been great here pushing back against the gloom. And I guess in crisis, it's normal to have gloom. Is the great contrarian call here to say that America will prosper?
For the next 2-3 quarters, absolutely. I think the economy remains really resilient, and I think that the Fed's policy challenges aren't going to go away. The volatility is going to stay with us, and I think yields right now have corrected down so far. I think we're headed back up again. I don't know if we get back to where we were, but I think especially in the long end, we're headed back up.
Laura, thank you so much. Greatly appreciate it with FS Investments. I wanted to cue the American patriotic music there. I mean, honestly, the great blown call of a lot of people over the last 12, 18 months who knew a bank crisis was coming, I didn't know it, is not the gloom, but the measured caution on our economic prosperity. I believe I heard Ms. Rahm say it's a 3% GDP. Nobody saw that.
You're being all Warren Buffett on us right now. You're basically, America is strong. And look, there are a lot of people who point to this resilience, and this is the tension, right? And this is the tension that Laura Rain was talking about. On one hand, you've got a Fed that doesn't want things to be this strong in terms of growth because that's what's going to cause inflation to keep going. So they're going to keep raising rates if we don't get a banking crisis. And then on the other hand, if you get a banking crisis, things go too quickly, and then it's out of control. So it's sort of, stuck between a rock and a hard place in every way.
I'm going to ask this question. I don't care if you don't like it. I mean, the interns over there saying, don't ask it. What's wrong with just pausing and letting Secretary Yellen and others handle a legitimate deposit fear? What's wrong with pausing and waiting for the data to come in, as Ms. Rahm suggested there with consumer confidence?
You're not alone. A lot of people are saying the same thing. Bob Michael of JP Morgan Asset Management adamant that the Fed needed to pause. A lot of other people agreeing with him, saying this is the time to assess those long and variable lags because there is an effect that's coming into the market. The concern is that inflation still is running pretty hot. So is there going to be a mistake on that side if they don't necessarily adjust?
The parlor game here, which you and John love, folks, how much I hate it. The bottom line is, I look at pausing, and you can say we're going to pause and we're ready to jump back on the inflation fear if we see it.
A lot of people would agree with you. On the flip side, if they had paused and then also said there's no banking crisis, everything is sound, then why'd you pause?
West Texas Intermediate, 70.21 in recovery. Torsten Slock at 8:30. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Silicon Valley Bank branches will open under a new name today. The FDIC says First Citizens Bancshares has agreed to buy the failed lender more than 2 weeks after its collapse. The North Carolina-based firm will purchase all of their deposits and about $72 billion of SVB's loans at a discount of $16.5 billion. Some $90 billion in securities will remain in receivership. Credit Suisse faces the threat of a possible investigation and disciplinary action over how top managers ran the bank in the lead up to its collapse. Switzerland's banking regulator told a Swiss newspaper that officials are considering options. She says Credit Suisse had a cultural problem that led to a lack of accountability. In Israel, Prime Minister Benjamin Netanyahu is considering a delay in his judicial overhaul plan after a night of demonstrations. Thousands protested after Netanyahu fired his defense minister for criticizing his plan to reduce the power of the Supreme Court. In Germany, it's a day of travel chaos. Air and rail services came to a halt due to a one-day strike. Workers are demanding bigger pay hikes because of inflation. And in France, unions are planning a 10th day of strikes tomorrow over President Emmanuel Macron's decision to raise the retirement age. Millions of people have joined the protests since January. And Apple CEO Tim Cook discussed supply chain issues with China's commerce minister today, and that underscored the importance of the relationship between the leading U.S. consumer tech company and its key partner. Apple is looking to diversify its production, but still its most important products are predominantly assembled in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
This time is different. I don't think we have quite the systemic issues in the banking system that we did back then. Obviously, the Fed now having raised rates so aggressively does have some ammunition, some dry powder to obviously cut rates and improve the situation. But it's what you don't know that you worry about.
Chris Marangi, with immense experience with the Mario Gabelli Funds, the co-CIO there. And I'm just going to say this, folks, it's simple. Guys like Marangi live for the sweat of this, the fear of it that's out there as being opportunistic. Jen Farrow, Lisa Bramwitz, Tom Keene, thank you for joining us on a Monday to stagger through the week. Mr. Farrow, on a key assignment. I had something to do. Conte was thrown out of the tots and, all of a sudden, I think he's, being interviewed for it, frankly.
I love how he's being interviewed for both, some central banking position as well as coaching the tots and, what's next?
Seriously, I think he's over talking to, Conte's out and it's going to be a changed team. To that point of Chris Marangi here, Lisa, and I think this is important, value guys like Mario Gabelli live for fear. Except this fear doesn't fear like the previous fears, if I'm somewhat clear on that.
There are enough people who live for the fear that the fear hasn't happened in market pricing. That, I think, is sort of the conundrum that people in equity markets are facing. And so how do you figure out what the opportunity is if the opportunity isn't as good as it would be without all those other people hunting fear?
What we're going to do now is look at the part of the market nobody's talking about because fear sells and cheerleading doesn't. And that is the 12 stocks that are going up, led by Microsoft and, of course, AAPL. And joining us right now, Alex Webb joins us from Bloomberg. Quick take here. Alex, I don't want to talk to you about financial ratios. I want to talk about something slipped under the zeitgeist, but is in your world over the weekend. Bloomberg owns the high ground on Apple rumors. His name is Mark Gurman, and he put out a blistering note over the weekend saying, everybody's got this wrong. Apple is aware of our most requested features. Are we underestimating Apple's dominance and their ability to innovate?
I think it's been particularly interesting if you compare Apple to Google in recent months, where people are suddenly starting to get very skittish about Google's mid to long-term prospects. A combination of ChatGPT, a ChatGPT boosted Microsoft, coming after them in search. TikTok, also a place where increasingly young people go to find their restaurant recommendations, and that's a space that Google has owned for a long time. We've realized, therefore, quite how resilient Apple is, the way that they are deeply rooted in people's day-to-day use. People have iPhones, they're highly unlikely to trade those iPhones in. The big threat coming up on the horizon, though, of course, is what is the next generation of hardware that is perhaps going to succeed the smartphone, and that is where Apple is throwing a huge amount of money when it comes to smart glasses.
And they have the huge amount of money. I mean, if I'm looking at 27 times multiple back up from 21 or whatever, it's been on a run, like Mr. Nadella over at Microsoft. And what I find, and Alex, away from your mission, I look at United Healthcare with a ginormous bond offering out there. Is this a time where Apple and others with persistent cash flow reload? Apple has 5.1% debt. Every classroom in the world would say Mr. Cook is handling that wrong.
Well, Apple has consistently said for the past 7-8 years they want to be essentially cash neutral. The challenge they have is that no matter how fast they sell debt, they also, practically print money because they have in the order of $100 billion of free cash flow every year. So it's a real challenge, actually, for Apple to get to that point. They are gradually getting there, but they are sort of, in that sense, a victim of their own success. They do significant buybacks. They have started returning more money to shareholders. They do not have the appetite for big deals that, say, Microsoft does with its, tens of billions that it's spending on Activision Blizzard. Apple sees not only huge execution risk, but also a lot of regulatory risk if you do that. They don't want to necessarily draw attention to parts where they might be a little bit dominant. So that money does come back to shareholders in various forms. It is still a challenge for them to do it at the pace at which they're making it.
You say regulatory challenges, and I'm sure you're talking about just in terms of the dominance in the industry, but there are challenges as well in terms of their business over in China. I'm curious how much that's sort of preeminent in the concern bucket for Tim Cook at a time when we're talking about TikTok hearings and we're talking about possible legislation.
It is a significant issue for Apple in many ways. I mean, he met with the Chinese Commerce Minister over the weekend. There was a lot of talk there about the symbiotic relationship between Apple and China. In many ways, Tim Cook is quite an important resource for China when it comes to ensuring that trade remains open with them, because more or less all of their iPhones are made there. Now, what we've started to see in recent years, they're trying to bring a little bit more manufacturing into places like India. It's far more easily said than done, not least because it's not just a question of having a factory there. You have to have the entire supply chain. There might be millions of jobs that are supported just making iPhones in China, but then you have all of the components that go into them, from circuit boards and beyond, that are made also in China. Now, you might have the really high-value semiconductors coming out of Taiwan, but a lot of the rest of the supply chain is local to the manufacturing it has there. It's very hard to unpick yourself from that. It is the work of years, if not decades.
How much, Alex, are big tech giants basically pitted against each other in this regime? I'm looking right now at Meta shares. I can't get over the rally that we've seen there. They're up more than 70% so far this year. And I wonder how they're going to potentially benefit if TikTok gets banned, because then they could just perhaps assume some of the traffic. Snap also up on that news. And then you have the likes of other companies, more considered staid big tech, that rely on China for doing business. How much are they sort of pitting their lobbyists against each other in Washington, D.C. right now?
Well, it is interesting because, of course, when you think about the software platform type companies like Facebook, like Google, and there's much talk of the bifurcation of global tech, that you have a Chinese ecosystem and then a sort of Western ecosystem. Google and Facebook do not have access to China. There's some cloud business that Google has there, but fundamentally the main search business that drives the lion's share of revenue isn't in that market. They don't particularly, therefore, count on it for growth. Apple, very, very different. Apple is in and of itself kind of a platform. It needs that market not just to manufacture, but also to sell products. So it is in a very different situation. One note of hesitation I'd say about Facebook is that when you think about the relationship with TikTok and the competitive threat there, in a sense, TikTok can be, in one sense, useful to Facebook because it can say, we don't have a monopoly. We have fierce competition in social media. Do not break us up. Do not come for us. Would you rather? And they literally do say this. Would you rather have us or the Chinese? That's literally something that Nick Clegg, the president of Facebook, will say. So there's a little bit of nuance in there.
Alex Webb, thank you so much. And again, folks, the path-breaking work of Mark Gurman. Look for it over the weekend on Apple. Mr. Webb, of course, coming from Queen Victoria Street in London. I really want to frame this, Lisa, and I'll let you do the news here. Isabel Schnabel, not only out of the German Economic Combine, but also out of Berkeley, was the star of Jackson Hole. She came in there, not as a stranger, we all know who she is, but she stopped traffic. The deer, the elk were out in the swamp, stopping, listening to Isabel Schnabel talk about the moment at Jackson Hole. Here she is again, moving markets.
Yeah, basically, Bloomberg reporting, people who spoke with the sources said that Schnabel pushed for the ECB statement to say that more hiking was possible. She basically was more hawkish on concerns of inflation, basically arguing against basically saying that we're done and really trying to remove any explicit wording, but also to indicate that it was important to be more aggressively tackling inflation. This isn't important because we have continued to hear that same kind of tone coming from ECB members, even as U.S. officials have been a bit more reserved with how much more is required.
And you wonder about dollar breakdown. We're back down to support on DXY. DXY is a major pairs. It includes the euro, 54, 56% as well, yen, sterling, and the rest. But the two-day DXY chart really gets you down to a 102 level. We haven't broken down yet, really, have we?
But this is really going to be interesting. Why didn't the euro rally? When you hear all of these hawkish prognostications, Isabel Schnabel basically saying we should guide to a higher rate. Yet, basically markets saying, no, you're not. The
news continuing here, and the headline news for those of you on radio and television across America, American banks doing better this morning. Stay with us. This is Bloomberg.
Welcome back to another special Miami Open update for Bloomberg TV and radio from the Tennis Channel. I'm Hannah Rad. Indian Wells champion Elena Rybakina takes her next step in the Sunshine Double Monday when she faces the talented Elise Mertens in Florida. Rybakina is on a 10-match win streak following her dramatic victory over former champ Paula Badosa and leads the Belgian 2-1 in their head-to-head going into this one. And don't forget, you can watch all the action exclusively live on Tennis Channel.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Central banks playbook: when there is financial stress, throw liquidity at it.
They don't believe we have a banking crisis.
This credit crisis is going to be disinflationary.
Those cuts that are priced by the market could be justified, but the conditions that would warrant those cuts would be pretty aggressively bad conditions.
When the Fed tightens, real things break, and unfortunately, real things are breaking now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Nothing broke over the weekend, so we're back to Risk On. We're also back with Tom Keene. He is back from vacation. Jonathan Farrow off. I'm Lisa Abramowitz as we look at a market, and I think you put it well. Why are we seeing Risk On? Well, it seems like there is calm. It seems like crisis, maybe not over, but paused.
There was elements of it last week within the true crisis that we observed. Some real heartbreaking moves. I mean, look at Deutsche Bank just on Friday was jaw-dropping, but everything, including Deutsche Bank in Europe, stabilized. And of course, in America, the banks have more than stabilized. First Republic advances this morning.
Yeah, and people are talking about this idea that nothing did collapse over the weekend. We didn't see another crisis. We haven't seen any kind of continuation in terms of small and medium-sized bank angst, and that is a sign that perhaps you could see resilience, natural credit tightening, and easier potential monetary policy.
There's nuances here in things, Lisa, about looking at the data. It's a busy data week as well. Michael McKee will be the star this week looking to the PCE numbers out later. But to me, the immovable forces are one, Laura Rahm talking up 3% present GDP, buoyant is how I'd put that. And the other one I'd look at is Jim Bianco saying, I'm sorry, it's a 5% world. And those are two different worlds, but they overlap and dovetail in some form of confidence.
But this is sort of the nodes of uncertainty right now. Do you have really hawkish central bankers, or do you have some sort of crisis that causes some sort of pause? I want to bring Seth Carpenter of Morgan Stanley, the global chief economist, over the weekend, coming out and saying, if disruption in the banking sector delays an extension of policy tightening, then a soft landing is still possible. But the downside risks have gotten bigger. The no landing notion never made any sense. Central banks were always going to force a landing one way or another.
I am so fed up with this. You know, it's like, come on, this started with V-shaped. I remember sitting in the studio with, I don't know, Gura McKee, I can't remember, maybe the late great Ken Pruitt, and we're looking at V-shaped, and nothing stopped from there. And it's just, what's the next phrase going to be? What's the thing out there that the media is going to say this is the narrative right now? I don't think there's a narrative right now other than survival based on flows of banking deposits.
And that, I think, is what's been playing out in terms of where the fear is right now. That fear seems to have abated. We are seeing a lift to the market. And I do think it's interesting how we were talking with Mike Wilson of Morgan Stanley about seeing opportunity in some of the financial stocks after what we just saw, still led by tech. The NASDAQ still doing better than good, to use your phrase, at a time when people see that as a stalwart of strength.
No, let's look at the data here quickly. Up 0.7% on the Standard & Poor's 500. That's a 4,000 level, Lisa. To me, that is the key thing in the back and forth and the gloom. This is a resilient market led by a few select things, as Alec Webb just talked about.
And today is a divergence from the trend of tech outperformance, where you see the S&P outperforming, up 0.7% versus the 0.4% gain on the NASDAQ. This being driven, this is driven though by this question around financials leading. You're seeing yields just a bit higher. Again, this is what happens. You see strength, you see stability. People start to price in more rate hikes, I should say, although just marginally, with just a slight tilt up.
Somebody said to me, how'd you get this cough? And I said, well, it's really difficult. If you were Stewart having a rum punch under the mango tree, and then you go out in the sun, and then the trick is if you go back under the mango tree, that's when, you know, you get that tourist cough.
I'm crying for you. Really, you're making me feel
difficult.
just, I'm.
Have you ever done the big cruise ship thing? Somebody stopped me down there, love the show, blah, where's Bramo? Is she as gloomy as she really is? and he said to me, you should really do a surveillance cruise. He was serious.
He was serious about that?
One of those cruise ships, like they go into Venice and they got 45 stories on them. Could you see Pharaoh on a cruise?
No, I think that he has made his position very clear. I'm not going to represent him, but I think that
but if the paycheck is enough, Pharaoh he'll be get out of my way. We're going on. I mean, come on.
It's going to be like Survivor, surveillance style. Basically,
I like that. Very good.
Survivor cruise with surveillance.
All
right, let's save this right now and get a sense of what's changed and how much we can kind of read into the optimism that we're feeling in the morning, at least for some sort of period of time. Lisa Hornby, head of U.S. multi-sector fixed income at Schroders, joining us now. Lisa, I want to get your sense of what's changed. Have we gotten enough stability in the lack of news over the weekend to go risk on today?
I think possibly temporarily. I think there's a bit of a sigh of relief that Deutsche Bank, amongst others, are still standing this Monday morning. I don't think we're quite out of the woods yet. I guess part of it is there's a bit of a sentiment swing. Everybody has gotten super bearish, and rates rallied really, really aggressively, and everything seems to be a little bit calmer right now. So there's probably a bit of a technical now pointing towards the positive direction. That being said, I mean, our position has always been that when the Fed tightens aggressively, it exposes the excess leverage, the excess risk in the system, and that is going to cause things to break. And we've certainly had an element of that.
It feels like people are having sort of this polar experience. It's either a bipolar experience where it's either the banks are collapsing, we're all going straight back to zero, and everyone's going to just basically hide under their mattresses, or else the banks are going to be fine, and then the Fed eases, and then everything's also going to be amazing. It seems like both narratives are kind of coming to a fore right now at a time when, by necessity, the Fed is going to tighten credit conditions in a way that will have to hurt. So at what point have we priced that into the credit spreads that still are below traditional recessionary levels?
I think the point you make just highlights how much uncertainty there is in the market and how much potential volatility there is to come. I mean, we could look at what's discounted for the end of the year in terms of Fed rate hikes and say the market's pricing in give or take 100 basis points, of rate cuts by the end of the year. Or we could say, well, that's actually 50% of the market that thinks there's 200 basis points of rate cuts and the rest who think things are unchanged. There's a huge gap, a huge spread in the views out there. And I think ultimately what that means is you need to be compensated more to take risk. You need more risk premium embedded in markets, not less.
Lisa, in CFA level 1, there's a point where you passed and I didn't, accounting asset liability of how bonds are accounted for. And the heart of the matter to me and the magnitude of the rate move we've had is held to maturity accounting. Do you at Schroders have any transparency or vision of the true state of held to maturity debt in this crisis, or is it unknown on a Monday?
Well, you're asking me to draw back on a few years here at CFA level 1, but the big banks certainly are regulated to a different degree than some of the smaller regionals that have become known in the headlines more recently. And certainly the size of those books were larger, in our view, than those of the major, the US GSIBs, and even some of the larger US regionals. So there's a threshold for when those books need to actually be marked to market and when they don't, and what needs to be reported in terms of unrealized losses. So, I guess the bottom line for us is you have to know what you own. And you have to know what is on those on the books of those types of issuers, and this is where credit analysts really come into the fore, because this is the type of environment where things like that are exposed, and we've certainly seen that over the last 3 weeks.
I looked, Lisa, at the opportunity for issuance here. We saw a ginormous healthcare issuance last week. Do you and Schroders think we'll see a lot of issuance out there?
I mean, there's certainly the last couple of weeks, there's been a very, very light. So we do think that there's a lot of pent up issuance waiting to come. Markets stay like this, I think we'll see a good deal of issuance. It's interesting, some of the healthcare issues that you mentioned actually have performed quite well despite all of the volatility. So it does show that there's still a bid for defensive healthcare pharma type names. I think that does tell you something about how the market's going to respond to future issuance as well.
Which dislocation over the past couple of weeks were you taking advantage of, Lisa? And I know that you think that perhaps you need to have greater risk premia, but are there any areas where there's enough baked in that you think this is an attractive moment?
Oh, absolutely. I mean, we were fairly defensive coming into this, and so there has been opportunity in our view in agency mortgages. There's some opportunity, and I think in the banking sector, you know, some of the higher rated senior U.S. GSIBs, I think that we've seen some opportunity there over the last couple of weeks, particularly in the more fraught moments. Some of the higher quality industrials, the more defensive names, as I alluded to with healthcare, there's, you know, the whole market has cheapened. The whole market isn't worth less. There's certainly diamonds in the rough, if you will, and so it's about spotting those. In our view, right now, you still want to err on the more defensive side, generally speaking. We still think there's more volatility to come in credit spreads. You know, we might be in for a little bit of a tactical bounce, as we said here. Market feels a little bit firmer today, and certainly people have gotten off sides and whipsawed with these moves, but there's absolutely opportunity emerging.
Lisa Hornby, thank you so much. With Schroders, and you see it, folks, in the 2-year yield, an 18 basis point move, higher yield, lower note price, 3.94%, not up to 4% yet, but there it is. Lisa, I think this is a huge conundrum, and I'm fascinated by the challenge that chief financial officers have right now, and how do you brief, or even more importantly for CFOs, how and who do you listen to about what to do with a portfolio or what to do as a next move in issuance? I don't have any wisdom on that at all.
Well, I think that this is really the conundrum for them, because they're looking out into a black box of whether rates are going up or down, and they're not sure what the borrowing environment is going to be like. So do you lock in borrowing costs where they are, yes, much higher than they were perhaps a year ago, but perhaps lower than they will be in another 6 months? And that's what you speak about, trying to capture a window and lock in what you know at a time of so many unknowns.
And again, you know, United Healthcare is, of course, what I was alluding to. And it's sort of like once they get going, they're like lemmings. And I wonder, with 1 or 2 more ginormous 6 phone call blue chip deals, that everybody just expands out their debt portfolio, is one of the great surprises of April.
It's the who, though, and this is important.
Yes.
It's the top-rated companies. The market's been pretty much locked for the lower-rated companies, and that, I think, has gotten some people concerned. It has to reopen for there to be the liquidity and the ability to fundraise and have IPOs that people are looking for to keep things going along.
Something to talk about here in the next 45 minutes, also European debt dynamics as well. Torsten Slok of Apollo Group. This is the 8:30 hour. Stay with us on radio and television on this Monday. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The failed Silicon Valley Bank has a new owner. North Carolina-based First Citizens Bank shares will buy about $72 billion of SVB's assets at a discount of $16.5 billion. As part of the deal, the FDIC will get stock appreciation rights in First Citizens worth up to $500 million. Authorities took extraordinary measures to shore up confidence in the financial system after Silicon Valley Bank collapsed. The head of Credit Suisse's largest shareholder has resigned after his comments helped spark a slump in the bank's shares. Ammar al-Qudari was chairman of Saudi National Bank. His remarks came in an interview March 15th with Bloomberg's Youssef Gamal Al-Din.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
Saudi National Bank says al-Qudari is leaving due to personal reasons. North Korea has test-fired 2 more ballistic missiles, adding to a recent barrage of launches. Kim Jong-un's regime had no immediate comment. The launches came as the U.S. and South Korea conducted their largest amphibious exercise in about 5 years. And Bank of America has agreed to a 10-year deal to sponsor the Boston Marathon, one of the world's oldest annual running. Starting next year, the race will be referred to as the Boston Marathon, presented by Bank of America. Terms of the deal weren't disclosed. BOA will take over from Boston-based John Hancock, which has sponsored the race for almost 4 decades. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch, and then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
Neil Kashkari of Minneapolis with Margaret Brennan on Face the Nation. You can hear Face the Nation. It's one of our truly. You want to know when I've been wrong, Lisa? Would you like to know? Like,
I'm dying.
They said to me, let's put the Sunday talk shows on Sunday afternoon on Bloomberg Radio. And the yelling and screaming. If you could hear me yelling 3 floors away, you're out of your mind. It's the dumbest idea I've ever heard. Day one, it was successful. It was stunning. How people would listen to Neil Kashkari with Margaret on CBS Face the Nation, 2 p.m. Sunday afternoon.
It's important to hear what big market-moving people have to say. I listen to these things. I think it's really important. The Sunday talk shows give you a sense of what's in the mood.
They're still a great tradition.
Going forward.
It is true. Of course, we did that with our NCAA bracket as well, the Damien Show. Let's digress here for a moment from his true expertise in emerging markets right now. I know there's never been a year like this. Does the gambling industry, is this a profit opportunity for them that March Madness is so mad? Or is it a losing opportunity for the industry?
Wow, it's a good question. I thought we were going to talk about emerging markets and global
macro. We're getting there,
we'll
but
get
this
there.
is more important.
No, absolutely. The numbers are through the roof. I mean, it's been fantastic for the sport. I mean, all the number ones are out. I mean, Houston, Alabama, Purdue, they're all out. So now you've got FAU. It could be, are you ready for this? University of Miami versus FAU. Could be South Beach versus Boca Raton in the championship game. I mean, they'd have to move the championship from Houston to South Florida just to basically accommodate the mass demand for...
But the ginormousness of it that you follow every day, you and Michael Barr with Bloomberg Business of Sports, the ginormousness of this, does it get even better when everybody's bracket is as bad as mine?
Well, I mean, it's within the bad, there is good, right? I mean, look at what's going on here with Jim Larinaga from University of Miami, George Mason channeling 2006. I mean, that was the quintessential upstate year. Here we are today, seeing much the same thing, right? With the exception of UConn. I mean, the Huskies look pretty dominant out there.
I wish you'd get as excited about Argentine peso as you do about George Mason.
Well, there's no balance. Payment crisis in EM. Everything is hunky-dory. I mean, the one thing that stands out in this move, Tom, and we've talked about it, Lisa and I, you were on break, is the dollar. I mean, the dollar's down in 11 of the last 13 sessions. You don't normally see that in a crisis situation such as like we've witnessed over the last 3 weeks. So for me, it's all about this dollar weakness in the face of it all. And what is that really telling me? It's telling me 2 things. It's telling me, number one, what you're seeing is 3-month, 10-year real yield curve in the U.S. flattening, real yield curve flattening significantly, which is a short-term indicator of what the cyclical situation for the dollar is. But secular long-term, maybe this is real dollar debasement. Maybe this is real lack of confidence because of moral hazard. And I know. I don't believe it. I know. But it might be a little bit of that also. See, sprinkle it all together. Dollar's been down pretty significantly. EM's been rallying pretty hard in the face of all this.
So people have been talking about the death of the dollar for a long time, or the diversification
Myself
to
included.
Gold and possibly the Chinese yuan as a possible reserve currency.
Should
so there
I
are all
just
sorts
leave
of things.
The room so you two can gloom out here?
No, but a lot of people are actually pushing back, right? Yeah. And you saw last week that even when the ECB came out and raised rates and indicated 2 weeks ago, but have come out with more hawkish discussions and rhetoric, you saw the dollar actually gain a little bit versus the euro. So we're not trading on rate differentials to the same degree. So what's the driver? What are people looking for? If it's not the haven play, it's not rate differentials, is it just a wash of noise and macro bets, just basically algorithms duking it out?
It is rate differentials, Lisa. Carry is the reason that you're seeing Brazil, Hungary, Chile, Mexico all up this year relative to Taiwan, Singapore, Israel, all the low yielders. So it is absolutely an EM a carry story, maybe not in G10FX. In G10FX, you've got the pound, the euro leading. So, yeah, I mean, you've got Noki and Aussie down. So, those high kind of yielders aren't really doing it in G10, but in EM, it is a nominal carry story for sure.
Okay, so if it's a rate differential story, at what point do higher rates in the face of higher inflation cause weaker economic
level
growth.
versus trend. We're
Right,
having
exactly.
a conversation of where does level matter, because right now it's all been about the trend. And I would have to say, I have no idea. You know, you're asking me to point out a vector on a piece of litmus paper and ignore all the zeitgeist. I can't do that. No, but I think really, truthfully, I think you have to take note why this time is a little bit different. Dollar weakness in the midst of this crisis.
I was having a rum tang down in the Caribbean, and Damien, I thought of you. Mr. Putin is talking about China and the yuan will be a dominant global currency. You and I have been reading about this what if for 30, 40 years. Do you actually buy the idea renminbi will be in some form a global currency?
I mean, I definitely do. I think at some point, you know, further on down the road, it will have, and it still does have it does have value as a reserve currency. I do, from a diversification benefit, but certainly not as a mechanism of payment. It's not nearly where the U.S. dollar or even the euro is at this point, and I don't think that's going to change in the foreseeable future, quite honestly. But you can't ignore China. And so what am I looking at? You asked the question. You didn't ask the question. I'm going to tell you what I'm looking at. I'm looking at export orders in Japan, Taiwan, and South Korea.
I'll ask myself
Because
the question
all that
and then I'll
matters
answer
here
it.
is the tug of war between China's economic reopening and the U.S. growth slowdown. And that's going to show up squarely in machinery orders, Japan, South Korea, and Taiwan. And what you're noticing is you saw a little bit of a rebound, but nothing to speak of. So that's where you have to be focused.
There's a guy with an Australian accent in my ear going, don't you dare ask him any more questions about March Madness. So instead I'll ask you about Australian dollar. I mean, you mentioned carry in that, but also commodities rolling over. There was a huge run on Aussie. Is that easy trade over of Pacific Rim commodities?
So what I've noticed, and it's a theme that JP Morgan's kind of hit on, is the fact that some of these currencies prior to the banking crisis were trading on housing markets, because really your housing market domestically in places like Australia, New Zealand, Sweden, some of these, the central banks can't hike rates as aggressively as you would otherwise thought without completely seizing their local housing markets, which are inflated to begin with. So a lot of people have been selling the currency of those countries that may have housing issues because they doubt that central banks can really hike to fight inflation the way maybe the U.S. or other economies can. So I think that's why you saw Aussie down, why you might see Kiwi down, why you might see Sweden down, even Canada, because their housing markets are in the, you know, they're not doing so great.
Okay, I want to just wrap this all together because there's a lot here. There's soup of emerging markets and March Madness, and it is the March Madness and markets as well of a different type. And the idea that we've been talking about is that the weaker dollar story has been a preeminent sort of question mark emerging from a soup of uncertainty and in certain sectors pain. I'm curious whether you think, based on some of the technicals that we've seen, whether it's sticky, whether you could see this actually persisting in a more meaningful way, or whether you think that this is really a head fake as people, again, grasp at straws to figure out what they can sell, when they can liquidate, and some of these other sort of more technical factors.
Well, we've hit it on the head, right? The reason, in my opinion, that the dollar is weakening is that there was such late positioning in foreign markets to begin with. That's what's different this time. In 2008, you saw heavy offshore positioning in emerging market currencies. You just don't have that this time around. So when you saw the, you know, the carry trade unwind of 08, when you saw the carry trade unwind of 15, you're just not seeing that to the extent this time around. And it's a little bit supportive.
March Madness in the markets, I love that, Lisa. It's really
I'm
what
sure
it's
I'm stealing it from someone. Other people have been mentioning that.
But we're going to give credit to Bramwell on that. March Madness markets, Final Four, Miami, I get it.
Yes.
Final Four, what do you think, Damien?
I like FAU Miami. I like an all South Beach sort of setup, and if it happens, I won't be there. I'll be here working.
Just want to be really clear. Where is your progeny going to school?
University of Miami.
Just making sure.
By the way, just so you know, I've lectured at both UConn and University of Miami. Both are playing and both have great student bodies, smart, electric kids, dynamic. Really excited to see that matchup.
What's your fee to talk and then to give your
I don't charge fee. It's just the fee of education and learning.
Gallons of Tang, or is it just pure orange juice?
With the rum,
With the rum in it. Good. Well, the Appleton's Tang is good. Damien Sassower, thank you so much with Bloomberg Intelligence. Truly intelligent here on the EM Dynamic. I'm going to quote what I was watching over the last week here as Argentinian peso. This is the quoted number, which is a 206. I haven't even looked black market. I don't know if it's broken through 400 yet, but the depreciation of the devaluation, I should say, of Argentine peso is there. And also, Lisa, it is idiosyncratic and removed. But Turkish lira 19.09, and you just wonder how that fits in to their incredible foreign policy challenges. I mean, that's a big number.
Yeah, at a time when they need to raise money to try to recover some of the earthquake aftermath. And, you really feel for that entire recovery process. How do they get the funds for that at a time when they really are seeing that depreciation?
There was no question over the weekend that the article within the zeitgeist of the most interest was from Adam Posen of the Peterson Institute. Dr. Posen here will join us on America's new domestic foreign policy. We may lose jobs. Stay with us. This is Bloomberg Surveillance.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance. Good morning, everyone. Jonathan Farrow, Lisa Bramowitz, and Tom King. Thank you for being with us. Mr. Farrow, off on a well-deserved three-day holiday. Lisa and I driving forward the conversation here. A constructive tone. Futures up 25, make it 26. 0.6%. Dow futures rock solid 200. 32,640 on the Dow. The VIX comes in constructively. 21.47. Look at Lisa, just as I turned away to have some Appleton Tang, the 2-year here, 3.96. We've come halfway to 4% just in the last 20 minutes.
This thing, I mean, John was saying it trades like
points.
a penny stock. I mean, honestly, the volatility that we've seen in the 2-year has just been off the charts, really historic at a time when nobody knows how the Fed's going to respond to data that no one can predict. So this is basically a vacuum of uncertainty that people are trying to trade around in, and you can see that reflected in the action.
The oil here, it's American oil up $1.33 now, again lifting up near 2%, $70.58. I mean, the fact is, it's a constructive Monday off of the Deutsche Bank caution that we saw on Friday.
And it's driven by the financial stocks. And you've heard that from not only the stock picture, but also from the bond picture just there with Lisa Hornby saying that they were picking up those financial bonds. So on both sides, people are saying this perhaps was a bit overplayed and they're diving in for those opportunities.
This next 30 minutes is extraordinary and what we love to do best. Thanks to our team for a lot of weekend work on this. Adam Posen will join us here at the 45 mark. But right now joining us, Torsten Slok, Chief Economist, Apollo Global Management. I really want to emphasize that Torsten, with his work at Deutsche Bank over the years and, of course, at OECD in Paris, gives a global view to the U.S. trauma right now. You are known for one paragraph, one chart. What's the one paragraph, the one chart that matters for Tuesday morning?
Well, what matters the most really at the moment is, as Lisa was just saying, the uncertainty about what is the behavioral reaction going to be in the regional banks and the banking sector more broadly as a result of what we're seeing at the moment. Because everything we're seeing on our Bloomberg screens tells you that, oh, maybe this is just a modest tightening in financial conditions. Maybe the OAS bank funding cost spread is out about 40, 50 basis points. But what we don't know is the second order effect, namely, what is the behavioral change going to be in terms of lending standards? Is it going to be harder to get a loan to buy a car, to buy a house, to buy commercial real estate, to buy anything for consumers and for corporates? And as a result of that, it is really still a bit unknown exactly how deep this is going to be.
Well, okay, I get the idea that there's unknowns here, but to me, what we may end up with is not only, maybe not a worry about concentration of banking, but you know what? We're going to clear the market, remove the people that couldn't make it from 0 to 5%, and will be stronger after the fact. Is that the Apollo view?
No, so the, of course, outlook here is mainly driven by the uncertainty about what is the response going to be in terms of how much tighter lending conditions will be. So if you look at the quantitative response in terms of pricing, I can see that on my Bloomberg screen, and that clearly shows that financial conditions are tighter and borrowing costs and funding costs for banks are higher. But if you then start to do small regressions and think about, well, what does the tightening in lending standards that we saw in 2020, which is where the FRA-OAS spread is, if that corresponds to what we're seeing today, then you might have more coming in terms of effectively a higher Fed funds rate relative to what we have seen in the data on my screen.
He's the only guy I know that actually understands the BTMM screen. I mean, that's what he's talking there with FRAOIS, the SOFR, SOFR, which Ira says is the new LIBOR. It's all Greek to me, but there it is.
This is the issue, though, for central bankers. They don't know how much additional tightening is being sort of implied into the market through a tightening in lending standards. And so if they're in the dark as well, if they don't have a clear sense of this, and the actual data that we're getting keeps on being strong, what's to stop them from continuing to hike in spite of all of the naysayers in the market that's screaming for rate cuts?
You're absolutely right. I mean, the whole situation here is a function of data dependency. The data dependency, if you say, I only look at the incoming data, then you are by definition backward looking. So if, of course, there's a lot of uncertainty about what's coming in the future, and you just don't know how to quantify that, and no one knows that at this point, we all have to guess what are the implications of this, then the risks are more tilted to the downside. But what the Fed and the ECB and all central banks around the world are now waiting for is this going to slow down the data? Are jobless claims going to go up every Thursday for the coming weeks? Will we also see non-farm payrolls begin to slow down? We've already seen durable goods and capex begin to slow down, but the bottom line is that we already had a slowdown coming because of the lagged effects of Fed hikes, and now we're adding onto that a banking crisis, and that, of course, increases the risks that the slowdown is going to be faster.
Is it fair to call what we have experienced a banking crisis? And this is really a question that people are trying to wrestle with at a time when we seem to see stability, and there are certain specific banks that had specific risks that blew up, and now we see ongoing sense of resilience. Is it fair to call it a banking crisis that's going to materially tighten lending conditions?
Well, it's fair in the sense that we have seen bank runs. And a bank run is normally the number one characteristic of a banking crisis. But what is very unusual is that this banking crisis is not like normal banking crisis. A normal banking crisis is because of credit losses on the illiquid part of banks' books. Now we're actually seeing losses not on the credit side, but on the most liquid side of banks' books, namely in treasuries. So in that sense, we have basically never before had a banking crisis in a strong economy. And that's really unusual.
So what's the distinction between a liquidity crisis, where it's just deposits being withdrawn, and a credit crisis? When does a liquidity crisis become a credit crisis?
So that's exactly why what matters now is how are the banks going to respond to this liquidity crisis? Are they going to say, it doesn't matter, we're just going to lend more? Or are the three headwinds they're facing from higher funding costs, also more regulatory scrutiny, and also ultimately a look at assets in a different way? Is that going to make them hold back? And if they do begin to hold back, the risk, of course, is that this could magnify the slowdown that is already, let's not forget, we were even debating a few months ago, oh, this will be a hard landing, even without a banking situation.
It's completely inappropriate for me to ask you about Deutsche Bank, but there I was in Davos standing with you and Mr. Saving long ago and far away as he was coming in to salvage the bank. Away from Deutsche Bank, explain to our American audience why European financial banking dynamics are so different and original from the American model.
Well, there's a lot of academic studies that show you that the deposit beta, in other words, how sensitive deposits are to interest rates, has tended to be lower in Europe. So that means also, therefore, that the propensity to move money quickly in and out of your accounts, like we're seeing in the weekly data from the Fed last Friday in the US, where money was moved from small banks, about 120 billion outflow to 60 billion inflow to large banks, that has basically a more significant, more pronounced effect in the US relative to what we see in Europe.
Over the weekend, the Financial Times did a full treatment of the Swiss culture in their banking. And again, it was 78% or whatever of the Swiss people are dead set against this mating of these two banks. Not on those two banks, but do the people of Europe have a voice in this? Or is it the elites above high that get to fix EU banking?
Well, one very important difference between the US and the European banking sector is that the European banking sector is much more dominant. In other words, we have a bank-driven financial
Robin
system.
Brooks had that chart out last night. Stunning.
And it's,
Lisa, stunning, the
it's
difference.
the first thing I worked with. I joined with Robin at the IMF in the early 1990s, but the conclusion is that it is very important conclusion that US has a market-based financial system, Europe has a bank-based financial system, and when you have a more bank-based financial system, the banks just play a more important role. And whereas in the US, remember in the US, the vast majority of credit in the US to the private sector comes from outside the banks. And that's very important because that, of course, means that the markets play a much more significant role. The US financial system is much more diversified. If you want financing as a company, you could basically go to many more sources in the US than you can in Europe.
So there are two different things here. There's less deposit beta in Europe than there is in the U.S., but there is a greater dependency on banks, so that it's more susceptible. It's an economy that's more susceptible to issues in the banking system. So if there is no issue in the banking system, if Credit Suisse was a troubled bank that had been troubled for a long time, that came to a head on a number of different issues, then is lending going to remain stronger and thus foster a stronger economy in Europe than the U.S., which is more susceptible to market pricing that's moving quick?
Well, that's correct. But the issue here is also what is the behavioral change going to be not only in U.S. regional banks, but in banks globally. And that's why if you do have a behavioral change where banks globally do begin to pull a bit back, then in a more bank-based economy, you would expect a more negative effect simply because the banks are playing a bigger role. That's why the diversification of the U.S. financial system, that you have so many more different places to go. If we were a company, we wanted to get financing, we could go to a bank. If that said no, well, then we could go to bond markets, to venture capital, to private credit, to private equity. There's so many more places to raise funds in U.S. financial markets, which is really the beauty of U.S. capital markets, that they are so much more diversified and therefore more able to provide the financing that's needed.
Well, we got to make a decision here. Lisa's going to take a break here before the important 9 o'clock hour here to get these markets open. Futures up 27. Torsten, should I lose the beard or not? I mean, that's really the basic.
Well, I started growing one like you here during the pandemic.
Yeah, but
so,
it looks suave on you. On me, you know, it's up and down. I mean,
well, you guys always look good here.
Well, Lisa, I know you're going to go away here, but we got to do this. We did a scientific survey, which you can only do off the Bloomberg terminal. It's like 1,280 something people say keep the beard, and there's one person who says lose the beard.
And that person is the most important person to you, and that is the bottom line. So that beard will not be here tomorrow.
I said to her, I mean, she's still bitter that Purdue was a loser in the first round of Farley Dickinson, but she grew up on the edge of the Elkhart Amish district in western Indiana. These are a hugely important part of the Indiana economy. And I got an email from her last night. She said, you got to lose a beard before you come in. I go, no, I'm not, folks. And she said, well, at least use honest Amish. And I was like, what? And she's Rachel's talking to me about honest Amish beard wax as being the only way to go. And it's what got me through the day here in terms of not itching.
Maybe you can like pair the beard wax with your bow tie wax, and then it could be lapel wax, and we've got a fully waxed Tom McKean. It's fantastic.
What we're going to have is, trust me, folks, we're going to have no beard tomorrow, and that's been a part of it. Part of it, Lisa, is to bring this back to what we do here. My travels shows a boom economy. There's no recession out there.
Which is really what Torsten was really getting at, which is everyone's looking around themselves and seeing everything's strong. So if you're backwards looking, you're going to keep hiking rates, but the forward look looks different. So how do you extrapolate out at a time where there's a dissonance between what we're looking at now and the reality that may come? Torsten Slok, thank you so much. That was fantastic to have you here, honestly. By the way, coming up on the Open, I'm going to leave because, I'm going to just, the wax is overwhelming me. Coming up on the Open, Ella Hocha of Pictet, Brian Levitt of Invesco, and Jack Manley of JP Morgan. We're going to be talking about the calm and how long you can bet on the calm as we look ahead to possibly what could be a more disruptive second half.
Small caps up 1.3%, and as you mentioned earlier, Lisa, NASDAQ behind. But I'm sorry, there's a certain oomph to this market this morning. I guess on the good news of the First Republic and the others up ginormous amount.
It's the good news of the lack of news. Nothing blew up. Yay, let's go in.
I do think that is tangible. Dollar weakness there, maybe off the Schnabel comments. Bloomberg reporting that Dr. Schnabel of Germany saying higher rates is still something that makes sense. Stay with us. Adam Posen next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Silicon Valley Bank branches will open under a new name today. The FDIC says First Citizens Bank Shares has agreed to buy the failed lender more than 2 weeks after its collapse. The North Carolina-based firm will purchase all of their deposits and about $72 billion of SVB's loans at a discount of $16.5 billion. Some $90 billion in securities will remain in receivership. Credit Suisse faces the threat of a possible investigation and disciplinary action over how top managers ran the bank in the lead-up to its collapse. Switzerland's banking regulator told a Swiss newspaper that officials are considering options. She says Credit Suisse had a cultural problem that led to a lack of accountability. In Israel, Prime Minister Benjamin Netanyahu is considering a delay in his judicial overhaul plan after a night of demonstrations. Thousands protested after Netanyahu fired his defense minister for criticizing his plan to reduce the power of the Supreme Court. In Germany, it's a day of travel chaos. Air and rail services came to a halt due to a one-day strike. Workers are demanding bigger pay hikes because of inflation. And in France, unions are planning a 10th day of strikes tomorrow over President Emmanuel Macron's decision to raise the retirement age. Millions of people have joined the protests since January. And Apple CEO Tim Cook discussed supply chain issues with China's commerce minister today. That underscored the importance of the relationship between the leading U.S. consumer tech companies and its key partner. Apple is looking to diversify production. Still, its most important products are predominantly assembled in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day, and if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
Yes. Not keeping. Look, people have conviction, or they invest for the. If they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Interest rates were clearly on the upwards path. The failure to do any kind of stress test about interest rate increases manifests a misunderstanding of what a major source of risk in the system was.
The former Secretary of the Treasury, Lawrence Summers, there with Bloomberg over the weekend, I believe with David Weston, and talking there about this banking crisis. If you're just joining us on a good Monday morning, it's simple. Pricing is better. Better in Europe. Pricing is better in America as well. 0.7% up on Standard & Poor's futures. The level there, I think, is just extraordinary. 4,028 on SPX futures, up 27 points right now. The VIX comes in constructively, 21.35. It is very important at Bloomberg Surveillance, it's been our tradition for decades, that we try to capture the zeitgeist among the adults in the room. This weekend, Jason Furman, who has to speak to Ec 10 in the room at Harvard, said, shut up and read it. And basically, shut up and read it is the new, to quote Furman, Professor Furman, phenomenal and hard-hitting essay by Adam Posen of the Peterson Institute. Dr. Posen is definitive on German culture. Dr. Posen is definitive of synthesizing together American policy and our economics. Adam Posen, I want to begin, first of all, with buried in your wonderful paragraph-by-paragraph article, is that Trump-Biden trade policy gives us the risk of losing American jobs. I thought we were gaining jobs by Intel factories from sea to shining sea.
Afraid not, Tom. Initially, you might gain a few. Thank you so much for the intro and for having me today on surveillance. The issue is, first, we've only got a finite number of skilled workers, people from these companies, Intel, Qualcomm, TSMC, Tokyo Electron. They don't have the American workers here who can do the job. And if they do, they have to hire them away from someplace else. It's not like skilled engineers are unemployed in the US right now. We need immigration to get that up. Second, if you put all this stuff and you force it to be built here at higher expense, then what you get is less competitiveness for the rest of the country. They're going to be paying more for semiconductors. They're going to be paying more for equipment. And that's fine if you think it serves some goal, but it's certainly going to hurt jobs. And third, you're never going to export any of this because what you're doing is you're bringing stuff home, so to speak, in order to make it uncompetitive. We've sort of done this with turning NAFTA into USMCA. We've increased the rules of origin, meaning more domestic content, and as a result, fewer exports. So on net, this is not a jobs creation program.
Someone who was definitive on this and the strength of the Peterson Institute was William Klein. All of our debate, including GOP and Democrats, is simplistic bilateral tension. And William Klein had the courage to say, you've got to think multilateral and differential bilateral of Singapore and China, Singapore and Mexico, Mexico and South Korea. How naive are we in a simplistic China-U.S. study?
Well, Bill is right, and I'm trying to make the same kind of case that there's what economists call general equilibrium, but in international relations, that the U.S. cannot simply say, we do this, you have to play along, and no one's going to react. Other countries, you mentioned Singapore, South Korea, Mexico, Australia, India, they have agency. They do not just have to passively deal with whatever the U.S. does. And if the U.S. decides to play hardball, to make them play along, then we become a police force and make enemies. So it's not a viable strategy. I wouldn't describe it to naivete. I describe it to overconfidence and ideological blinders.
Adam, at gunpoint years ago, I was forced to read Ricardo 1817 cover to cover. And to be honest, folks, David Ricardo, who is so much of this based off of in 1817, you know, it's a tough read. There's some distance to it centuries ago. Adam Posen, our trade policy is based from a distance on maybe Bretton Woods, maybe the middle 20th century. Do we need a new trade policy for a more open technological world?
We need a new trade policy in the U.S. because we haven't been open. The rest of the world's continued to open up, continue to do more trade, more investment. And as I argued in a foreign affairs piece a couple of years ago, the U.S. has been deglobalizing basically since NAFTA, certainly since 2000. And so all this blaming everything on the China shock doesn't make any sense because every other country was exposed to the China shock and they continued to grow, or they had the same decline in manufacturing jobs. You mentioned Germany. We did a look at North Rhine-Westphalia, the Ohio of Germany, and compared it directly with Ohio. They lost more manufacturing jobs than we did, despite their trade surplus, despite all these things that the Americans claim the Germans did. And so our trade policy isn't the problem. It's our politics that is the problem that refuses to recognize that America can't have everything it wants and that some people in rural manufacturing jobs have to adjust like the people who've been in services in cities have adjusted through the years.
Can there be a middle ground in Washington on trade, or do we just need to live to the polarity that we've seen for the last 8, 9, 10 years?
I'm not sure this is one of the few issues, Tom, where I don't think it's an issue of polarity. I think it's a large part of the Democratic Party and large part of the Republican Party have come together.
My error.
No, it's fine. But I mean, just to say the extremism is the majority position. And just as on other issues, like communism in the 50s at home, like environmental issues before the 70s, like civil rights, I don't mean to say this is on a par with those, but just to say Congress and the popular views sometimes are wrong. We have to confront that these views, even if popular and widespread, are wrong.
Adam, you lead with America's zero-sum economics. I mean, this is like Chad Jones out on the West Coast talking to a Solo 101. I mean, how do we get away from what we all intuitively understand is not a good thing, zero-sum economics? How do we get back to something constructive off of Solo 1957?
Great question. I think there's two tracks. One is we have to be more aggressive about confronting China and others in the diplomatic and military space. This whole part of the whole trade issue is people in foreign policy security not wanting to do the dangerous and hard work on the security side and hoping they can beef up the security side, pick a few technologies, really cram on that. The second side, as you said, is Solo-esque or Robert Gordon or anything like that. Huge public investment, yes, not industrial policy to exclude other countries, not industrial policy to maximize production at home, but made by America instead of made in America. Money towards R&D, money towards education, money towards supporting standards that let us get innovation from the free world. Those are the two tracks I would go on for made by America instead of made in America.
Adam Posen, wonderful to get started here on our IMF coverage here. And of course, this article, folks, I really can't say enough about. Don't listen to me, listen to Professor Furman up at Harvard. America's zero-sum economics doesn't add up. It is without question the read of the weekend from Adam Posen of the Peterson Institute, and a good launch for our coverage that you will see from original spring meetings of the International Monetary Fund. I got goosebumps about it, folks. We're through the pandemic. We're back to some form of normality as IMF moves to Morocco in October. And all I can say is these meetings, even with the banking crisis in place, are really, really important. Let me get back to the good news that we see in the market. Lisa Bramlett will drive forward the John Farrell Hour. That's a new name for it, by the way, the John Farrell Hour. And Lisa's going to be doing that for you. Mr. Farrell on a holiday for a number of days here. Futures up 25. Dow futures up 221. The VIX 21.43. Very constructive market led by small caps up 1.2%. Big lift there. The real story in the last hour has been the 2-year yield with a vengeance up 19 basis points. That's a huge move for those keeping score. 3.96% as well. Curve disinversion and the real yield. This has been something that Torsten Slack was talking about here. Just a leveling down of the real yield. Really an interesting conundrum there as we have many Fed speakers today. I'd also note on oil up $1.38 here on West Texas Intermediate, 76.33 on Brent crude, 70.61 on West Texas Intermediate, seeing some kind of the move equivalency in Germany as well as they end their day. Some dollar weakness as well. It is a Monday of an extraordinary week. Please stay with us through the week on the through the week, I should say, on the American banking crisis. And the good news is America's smaller regional banks, they advance this morning. Please stay with us on radio and television. This is Bloomberg.
Breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A constructive tone to the markets because nothing collapsed. Everything was fine over the weekend, and so you are seeing banks outperform. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, First Citizens Bank injecting fresh optimism into markets. U.S. authorities said to be considering additional support for First Republic as Fed speak returns with a warning on recession risks. We begin with the big issue, closing out a volatile month of March.
The volatility, I got to tell you, it is pretty crazy. The bond market's volatility here recently.
The bond market is pleading with the Fed to cut rates.
The bond market is somewhat, dismissing the Fed's dot plot.
The market is on a hair trigger waiting for the pivot.
I think we're going to get a lot more volatility.
People see, different statistics being reported from an economic standpoint.
We're entering a period of higher economic volatility.
And then they see stories about Credit Suisse, stories about Silicon Valley Bank.
The volatility in bank spreads.
The banking sector is really, it runs on confidence.
Whether it's rational or not doesn't really matter.
A lot of sentiment and a lot of kind of, emotions.
The volatility is still going to be with us for a while.
Because right now, markets and Fed are playing a game of chicken.
The key question is, who is right in that scenario?
Joining us now, TPW's Jay Pulaski and Ella Hoja of Pictet Asset Management. I love having both of you here because we have a bull, we have a bear, we have people who look at the same picture and come up with a very different scenario. Jay, I want to start with you. Everyone talking about the banking disruptions causing a potential pause in the Fed's rate hikes, possibly rate cuts. You see this as the moment you've been waiting for. Please explain.
Yes, Lisa, thank you. I think we're moving through the COVID period. Or we have moved through the COVID period, we're moving through the inflation period, and SVB and Credit Suisse have acted as a fire break. They've proven to the Fed that certain parts of the economy, namely the big winners from the ZIRP and work from home era, cannot handle rates any higher than where we are. So the Fed is now effectively done while the rest of the economy is in pretty good shape. Housing has bottomed. Supply chains have unsnarled. Manufacturing is doing well. I read a quote over the weekend. There has never been a better time to build a factory in America. That actually came from Volkswagen. So there is an awful lot going on, and I think we're moving into a high nominal growth economy. We're not going back to the 2010 low growth, low inflation. The Fed is going to move off its 2% inflation target. It's totally arbitrary, and I think we're about ready to break up and out. The market has had every opportunity to break down. It has not done so. If I was a bear, I'd be very worried. I think we're going to be led higher by the cyclical and other segments of the market that have been priced for recession, a recession which is not going to happen.
All right, Jay, there's a lot to unpack there, but I'd love Ella to weigh in here, especially because, Ella, you are more cautious on your outlook and in your investment allocation. So how would you punch back at what Jay was just saying, which is basically, well, you should be worried?
Right. I mean, for us, it's a very classical boom-bust scenario. And typically in monetary cycles, when the Federal Reserve tightens a lot, and in this case, other global central banks, we tend to have a bit of a blow-up scenario. And that's kind of manifested now in banks. Last year, it started in the tech sector. So the market, at least the bond market's telling you you're already pretty tight. And certainly the bond market has a very good track record, particularly in terms of the curve inversions and telling you where the economic cycle might be going. So we believe that we're probably pretty close to a contraction, and what's happening in banks is reflecting that, and the cost of borrowing for banks is going to go up substantially given the recent turmoil, and that tends to feed into more expensive credit for the economies. And so for us, that's just preceding a bigger slowdown down the road, and so we think that is not a good mix for risky assets. And so we'll definitely take the other side to what Jay is saying, that maybe we're in different continents, I guess, so different takes.
Well, Mike Wilson is on the same continent as Jay Pulaski, and Morgan Stanley's Mike Wilson, seeing more risks ahead for stock earnings. Take a listen to what he had to say.
Last year, we saw a pretty big degradation in multiples, but as we pointed out again today, all that was due to higher interest rates. None of it was due to higher risk premium, which is the part of the multiple that is, pricing in what growth is going to be. The market is starting to revalue or devalue what I would say the companies that are most at risk of missing estimates. And because the bond market just repriced itself overnight, we think that risk for the equity market is elevated now more than it's been for the last 6 or 12 months.
So, Jay, how do you take a look at what some people are looking at with respect to more expensive credit, as Ella is pointing out, and the potential for earnings to decline in the face of the expected tightening, the expected decline? How do you take a look at that and say, look past it? It's not going to matter.
I don't say look past it, Lisa. I say don't expect it. To Ella's point about the central banks, look, we have 4 major central banks in the world. The Fed and the ECB are tightening. The Bank of Japan and the PBOC of China are easing. I'll quote you the S&P Global Composite, which just came out for the month of February. It was at 53. 50 and above indicate expansion. We are not in a contracting economy. We're actually in an expanding economy, and yet people just refuse to kind of recognize that reality. And the bears, like Mike Wilson, who I respect, but he's been bearish forever. And the market has refused to go down. So I think if we're not going into recession, and look, Morgan Stanley, Goldman Sachs, and others have come out and bounded what they see as the risk to this kind of credit contraction that people keep talking about. It's in the tenths or 0.2 of a percentage point for the year towards the end of this year, Q3 and Q4, 0.2 of a percentage point. So that is not a reason to change your allocation. And people love to talk about cash. Cash is underperforming global equities by 260 basis points year to date. It's not the great asset that people keep talking about.
But Ella, some people have argued that on the cash side, at least you're getting about 5% yield. Now that cash levels have come down a little bit, or at least if you look at 6-month T-bills, we're looking at 4.6%. When do you know what's attractive? What's your sort of benchmark case for where Fed funds will ultimately end up, where inflation is going to be, and what you should target in terms of a return bogey?
Well, it's quite simple for us. It's very rare in markets that you get opportunities where it's difficult to beat cash. And that's certainly been the case recently. So there are pockets, for example, in bond markets, so in high yield, where you're starting to carry a little bit now, but given the backdrop of economic risks, that's still not attractive to us, not yet. But anywhere else, if you look across the yield curve, I mean, the 2-year yield that you have on the screen here, it's basically difficult to beat cash and very difficult for global bond managers like ourselves to actually find the right solutions given the risk reward available. And if I look at the equity space and you look at earnings yield there, that also struggles to beat cash in the context of what we believe to be a slowing down of the global economy. So for us, actually, it's hard to say, but cash is not trash, I think is very valid here.
All right, well, we're going to carry this conversation forward. Meanwhile, markets are poised for another volatile week. Plenty of Fed speak on the agenda. Minneapolis Fed President Neel Kashkari kicking things off just yesterday, sounding the alarm about a possible recession. Take a listen to what he had to say.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch, and then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
So this is the big question. How much is this going to really bake in rate hikes, sort of effective rate hikes into the economy? Michael McKee joining us now. Mike?
Well, Lisa, we are going to be watching Fed bank deposit information and the Fed balance sheet information and the senior loan officers survey going forward, as that bank question is the one that's hanging over the markets. Here's where we are. Of course, we had a meeting last week. It was the most anticipated Fed meeting in years and years, and the Fed chose to fight inflation over propping up banks. They raised rates. Markets now have decided, those who trade in overnight index swaps and Fed funds futures have decided the Fed's crazy. They're pricing in rate cuts, 4 by the end of the year. Banks look like they're going to open the week higher, but the fallout, as President Kashkari said, remains unclear. So where does that bring us? To the most anticipated Fed meeting in years on May 3rd. So we've still got a month, 6 weeks really to go. What's going to happen during that week? Well, one of these two lines is going to move, and it's not going to be the green one. The green one is the Fed dot plot median. The red one is what the overnight index swaps are pricing for Fed rates, and it looks like they are significantly below where the Fed is with those rate cuts priced in. But as the data come in, we'll see where they move. Do they move up towards the Fed or farther away? And speaking of data, here's our calendar. This week, we hear from a number of Fed officials. One of the more interesting ones, Michael Barr, tomorrow on what happened with SVB. But most of these things won't matter. The PCE numbers at the end of the week probably matter more to the markets than these speeches, because the speeches are going to have to change depending on what the data say. And you can see at the bottom of the, or I guess on the right-hand side of that chart, where the big data points are going forward, Lisa.
Yeah, the PCE inflation is going to be really key. And then, of course, everyone's just waiting for the senior loan officer survey on May 8th. Mike McKee, thank you so much for that. Jay, I want to go directly back to you. Ella and Jay both still back with us. But Jay, you were talking about how you don't believe that this Fed has the stomach to go all the way back down to a 2% inflation rate, that essentially this is the beginning of abandoning that peg, despite the fact that Fed official after Fed official have come out and said, we are not going to abandon the 2% peg. What makes you think that we're effectively going to do that? What sort of is the concern that overrides the desire to bring price stability back to that level?
Well, Lisa, I think the important thing for the audience to recognize is that it's a completely arbitrary number, right? That has only been in place for the last decade. It was accepted by the Fed in 2012. It's completely arbitrary. There's nothing that says that 2% inflation is the right level to have. It could be 3, it could be 4, it could be 1. It's totally arbitrary. So I think the important point is, as I noted, SVB and Credit Suisse, particularly SVB, Credit Suisse has been the sick man of Europe for a decade, is showing that certain segments of the economy, which really benefited from the zero interest rate policy, cannot absorb higher interest rates because they're already breaking. And so to me, that allows the Fed to continue to see inflation come down. We expect at TPW for inflation to continue to decline through the rest of this year and end up around 3% by the end of 2023. And we think the Fed is not going to come out and change and state the change. They will just allow for the inflation rate to be at that level. And this is something, Lisa, that has been in discussion amongst the policy and academic circles for much of the last year. And you've had people like Oliver Blanchard, former chief economist of the World Bank, come out and say that the Fed should do exactly that. We're approaching a new high nominal growth rate world, and therefore the policy mix of the 2010-2020, when 2% was introduced, is not appropriate for the environment we're going into.
Well, Ella, I'd love your response to this, especially from a European vantage point, where we heard Isabel Schnabel, as reported by Bloomberg this morning, was actually pushing for the statement from the ECB to include that rates were going to go even higher from here. Do you think that there is a greater aversion in Europe to allowing inflation to remain above that 2% target?
Probably the opposite is true, actually, Lisa. I think, a lot of respect for Schnabel. She's been a good guidance for markets and a very centric in terms of the ECB debate and to help us navigate that debate. But Europe faces constraints. If you look at the banking system, the European-wide deposit guarantee scheme is not exactly there, and it's in the same setup that you have in the U.S. And in terms of Europe, you're as strong as your weakest link is still valid. You have, the periphery that's bearing quite a bit of debt. So I don't think that a very, very high interest rate environment is viable for Europe. So on a relative basis, we would actually say that Europe may have to suffer more inflation. But just to quickly pick up on what Jay was saying, so this 3 to 4% inflation argument, you're assuming that the bond market is going to sit back and take that, right? So we have a big regime in central banking speak, and we say 3 to 4% is the new norm for inflation. I would see a very bearish setup for bonds, in which case it's very difficult to not see risky assets be taken down with that.
Well, a lot to dig into. Ella and Jay, both of you are staying with us, Jay Blosky and Hella Hoja. Coming up, a fresh dose of hope for the banks.
Silicon Valley, the FDIC was able to sell that over the weekend to First Citizens. So both of the failed banks have now been sold to private banks or banks that are publicly traded. So we're moving in the right direction.
More on that conversation coming up next.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the okay is getting ready to make
The crisis has really quieted down, and I think as the deposit flight has pretty much, I think we're going to find by the end of this week, slowed down to a trickle. It is calming down, and you saw, of course, that Silicon Valley, the FDIC was able to sell that over the weekend to First Citizens. So both of the failed banks have now been sold to private banks or banks that are publicly traded. So we're moving in the right direction. Is it the all clear signal? Probably not, but we're getting darn close.
First Citizens' purchase of Silicon Valley Bank capping 2 weeks of turmoil in the banking sector. But shares of some of the most battered lenders are rallying in pre-market trading. First Republic leading the move higher amid word that more support for banks could already be in the pipeline. Bloomberg reporting, quote, U.S. authorities are considering expanding an emergency lending facility for banks in ways that would give First Republic Bank more time to shore up its balance sheet. Team coverage starts right now. Bloomberg's Anne-Marie Hardern alongside Kaylee Linesdown in D.C. Kaylee, I want to start with you. What's the latest?
Well, of course, you had the news about, or the reports at least, that the U.S. government is looking for ways that it could help shore up First Republic, help that bank to survive. We also finally got the news that the FDIC found a bidder for the failed Silicon Valley Bank after a number of weeks. First Citizens agreeing to take all of those $72 billion in assets at a discount of $16.5 billion, which is why we are seeing in pre-market trading, of course, we're showing the Friday moves here on the board, but in pre-market trading right now, First Citizens is up 53%, while First Republic is up by 30%, and you have other regional banks like PacWest and Western Alliance higher as well. Of course, these moves only go so far to undo the damage we have seen over the course of the last several weeks. The regional banks, as a Spider ETF, is down by about 28% over the last 3 weeks, even more than that over the last year. It is underperforming the broader financials because, of course, it is these regional banks that we were concerned about deposit flight and whether or not they could remain healthy and solvent. And, of course, we saw evidence of that deposit flight in data out on Friday. Granted, it was only data on deposits through March 15th, which was, of course, the week of the collapse of Silicon Valley Bank and Signature Bank. We saw a record weekly drop in deposits for smaller banks of $120 billion. That's about 2% of the deposit base. So the question now, Lisa, becomes, has enough been done to stop the bleeding?
Which is the question that brings us to Anne-Marie. Anne-Marie, are there discussions ongoing about deposit insurance, about other measures to shore up the system, or is crisis over? Let's move on.
Well, certainly it's not crisis over, right? And our reporting over the weekend is that officials are keeping a very close eye on First Republic to the point where they may start to amend this lending facility at the Fed so they could shore up the bank. But they are not concerned about the severe flight we saw in deposits of Silicon Valley Bank, which, of course, the FDIC had to step in there. But they are still looking at potentially what can be done with First Republic. And this is one option that they are weighing, Lisa. We should note there has been no decisions. There's going to be a ton of hearings, though, today. So this is not, this week. So this is not going away in terms of lawmakers wanting to look at with the regulators on what went wrong. But we should also look at what Secretary Yellen said last week. She made it pretty clear that if warranted, regulators and the U.S. government will step in.
All right, Anne-Marie, Kaylee, both of you, thank you so much. Moody's Analytics Chief Economist Mark Zandi tweeting yesterday, the banking crisis is not over. Depositors remain on edge and continue to pull deposits from banks, moving their cash to money market funds. Money fund assets jumped again in the week ending last Wednesday, and are up more than in the past 2 weeks than any time, save in the pandemic shutdown. Still back with us, Jay Pulaski and Ella Hoja. Ella, I want to start with you. How concerned are you about ongoing stress in the banking system?
Obviously very concerned. It remains the epicenter of how you transmit credit into the economy. But, having said that, we've seen repeated actions to try and shore up the banking system. So certainly when it comes to the U.S., we believe that eventually that will be done, right? So we will buy some of the confidence back from investors. It's a little bit more tricky in Europe, but it won't be for lack of trying. So we're seeing similar types of actions and tools available in Europe as well. Now, having said that, can you always get an accident? Of course, that's possible, but we would actually say that there's very little appetite to have a full-blown banking crisis. What concerns us over and beyond the banking sector, however, it's issues that pertain more to where the mispricings in assets have been over the course of the last 10 years plus. And that's effectively started with tech last year, and it's likely to feed into private assets, but it's more likely to be a drip case of weaker price action there rather than a full-blown immediate event.
Which is sort of the drip that people are expecting from credit tightening as well. Jay, from your vantage point, do you see this as a potential opportunity that the banking system is strong and that you can go in and take advantage of some of the dislocations in smaller and medium-sized banks? Or do you see this as needing to continue in order to get the Fed to truly back off the way you're talking about?
No, Lisa, we've been focused on the large cap banks, both in the U.S. and Europe for some time. We continue to hold both XLF and EUFN. As you know, we focus primarily on ETFs. Those are the U.S. and European bank ETFs. And to our view, we don't see the risk of any widespread systemic problem, in large part because there are no major imbalances in the economy, whether it's consumer, whether it's corporate, whether it's the banking sector. There's nothing systemic. There's been no deregulation or dramatic deregulation. There's been no loosening of lending standards. I do think there is a commercial real estate issue. We're in New York City, obviously. It's evident every day you walk down the street. And that's one reason why we would stay away from the small and medium-sized lenders, because they are particularly exposed there. But that's a slow-moving process, right, that takes place over years. There's not a kind of sudden stop in the commercial real estate space that would lead to a sudden and systemic crisis. So I think the risk of systemic crisis on either side of the Atlantic is quite limited. We have been holding and have held through the last 2 weeks both of our positions in the financial sector. We do think cyclicals, including financials, are attractive because they've been totally trashed over the last 2 weeks.
Ella Hoja, thank you so much. Jay Pulaski, you're sticking with us. Coming up, the morning calls, and later the dot plot doesn't matter. This Fed is done hiking. That is the view from JP Morgan's Jack Manley. He joins us around the opening bell.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Baird downgrading Caterpillar to underperform, seeing mounting headwinds stemming from the ongoing banking crisis. Next up, Deutsche Bank upgrading Corning to buy, expecting Q1 results to mark the bottom for earnings. And finally, Citigroup upgrading KeyCorp to buy, saying the risk reward looks appealing after stress testing the regional banks. Coming up, the banks rebounding amid the prospect of further U.S. support. That conversation coming up next with JP Morgan's Jack Manley. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, we do see a constructive tone to the markets led by the financial sector. We have seen the S&P outperform the NASDAQ, which is a departure from what we've seen over the past few sessions. 0.6% gain for S&P, NASDAQ up 0.2%. If you flip up the boards, you can get a sense of what we're seeing in the yield space, which is higher yields as people take a look at the prospect for stronger growth, a banking system that's under control. Crude just up marginally, $70.65. loss on the NYMEX and a bit of dollar weakness. Euro 107.93, gaining just about 0.3%. One stock to watch at the open, First Citizens. The lender's purchase of SVB sending regional banks higher to kick off the week. The CEO writing in a statement, quote, "This has been a remarkable transaction in partnership with the FDIC that should instill confidence in the banking system." Kaylee Lyons back with us for more. Kaylee.
Well, we're seeing obviously a massive move, as you said, off the back of this, Lisa. First Citizens is getting $72 billion in assets at a discount of $16.5 billion. This acquisition will transform it into one of the top 15 banks in the country in terms of size. And we actually were just hearing from the CFO on an investor call saying that the deal brings in $35.3 billion in cash to First Citizens. And they believe some SVB clients are now going to return. So we have a nice 49% move in the shares here. It's also a big move for First Republic, up about 30% in the first moment of trading. This is after a Bloomberg report over the weekend that the government is looking for ways to extend emergency lending facilities for banks in a way that would allow the lender more time to shore up its balance sheet. Because as we know, Lisa, the balance sheet of many of these regional lenders has changed dramatically in recent weeks. We see that evidenced in the latest data out of the Federal Reserve. Essentially, what is happening is deposits are fleeing and banks are borrowing to aid liquidity. The end result is after $250 billion in bank borrowing in the week through March 15th, liabilities went up despite deposits leaving by a record $120 billion. So it speaks to the ongoing difficulty faced by regional lenders because, yes, we have the regional banking ETF up by about 3 to 4% right now at the opening bell, but it still is down by more than a quarter over the month of March, Lisa.
Kaylee Lyons, thank you so much. Across the Atlantic, we're watching Deutsche Bank bouncing back after closing at its lowest level in 5 months. The sell-off prompting German Chancellor Olaf Scholz to publicly back the lender, saying there's no need for concern. Joining us now is Bloomberg's Jan-Patrick Burnett. What happened here? Do we have a sense of what exactly transpired and why we're seeing confidence now?
Well, it's usually pretty scary if officials have to come out and bag a bank publicly. In this case, I think it's well deserved, and we have several analysts as well coming out saying Deutsche Bank is in good health and has good fundamentals. The move on Friday was probably a little bit overdone with concerns that there are any issues at Deutsche Bank. So the stock is up by about 6% this morning. Still, it's open to debate how big of an impact banks will see on their earnings if we go into a recession. So we will see how long these gains last. In other news, we learned today that Credit Suisse top management might face some scrutiny from the regulator on how they run the bank before they were taken over from UBS. And the Saudi National Bank chairman stepped down after his remarks about absolutely not backing putting further money into Credit Suisse caused the European banking crisis in the first place. So constructive environment today for European banks, but we will see how long that lasts.
And Jan Patrick, that story with the Saudi National Bank chair, really interesting considering how much that fund has lost on their bet on Credit Suisse. Sticking with the bank, Citigroup raising its price target on UBS while reiterating its buy rating. The analyst writing, quote, "We no longer assume the company reports a statutory loss in 2023 and believe the deal will be EPS accretive on an underlying basis from 2025. The inclusion of excess capital in our valuation causes us to increase our target price to 26 Swiss francs from 24 Swiss francs previously." Still with us, Jay Pulaski of TTW. And you were talking, Jay, earlier about how you like the major banks. What about major European banks?
Yes, Lisa, we prefer the non-U.S. equity space. As you know, we're global multi-asset investors. And so our very simple shorthand is that the Fed is done raising rates. That means the dollar is going to go down, and that's bullish for non-U.S. equities. And we particularly like, in the developed space, Europe, including European financials, which has been a long-standing position of ours, very cheap, plenty of liquidity, plenty of support. The European economy is not likely to go into recession, contrary to what people have thought over the last year. We also like Japan, and in the emerging markets, we like China and Mexico. So we think there are a lot of opportunities out there, Lisa, and as we move into that high nominal growth world and avert a recession, certainly on a global basis, investors now fully cashed up are going to need to start putting that money back to work. And we think European banks, as well as broad Europe equities are an attractive place on a 6 to 12 to 24-month point of view.
Jay, your vantage point leaves some questions, as Ella pointed out, about the bond market and what we've seen in terms of a repricing of Fed rate hikes, but also a repricing of longer-term inflation expectations lower at a time when you're talking about it possibly being a higher inflation world for longer. So how much of a repricing needs to happen in the benchmark bond indexes in order to get to the place that you expect we get to?
Yeah, Lisa, that's a great point, and we're quite underweight fixed income across the board. It's roughly 30 to 40% of our benchmark, and we have about 15% allocated, virtually none in the sovereign space. We actually like credit because we don't think there's a recession coming. We like credit in both the U.S. and in emerging markets. So I think you're absolutely right. Bonds at this level are not attractive. And so bonds are going to back up as the market kind of understands that the Fed is done. We priced that part in, but now we have to price in the fact that we're not going back to that low growth, low inflation environment. And so I do think you're absolutely right. The inflation expectation side is going to need to go up, but it's not going to be the same surge that we saw from 0 to 5%, right? It's going to be, let's call it on the 10-year, 3.5 today to 4, 4.25, 4.5, which is where it was, a couple of months ago. So I think that's going to be very digestible. And as the market sees that we're going into an economic recovery, risk assets are going to be able to absorb that back up in rates quite reasonably.
Jay Pawlowski, thank you so much for providing your perspective. Mega cap tech attracting investors as well, looking for shelter, and that's something that we've been seeing despite some of people calling for tech underperformance. Apple shares up almost 8% over the past month, and you can see that same kind of move, all even bigger in Google and Microsoft, 15.7 and almost 12% or 11.5% for Microsoft. Here's what eToro's Ben Laidler had to say about this.
You look for those long duration assets that benefit from lower or at least capped bond yields, and that's tech and that's traditional defensive. So I think they tick all the boxes, and the things that are going to hurt here are the more cyclical assets, the ones that, where earnings are going to fall faster than we thought.
Joining us now to discuss is JP Morgan's Jack Manley. Jack, how do you weigh in here when we see big tech outperforming after all the naysayers that in a higher rate world, this would be an area of great underperformance?
Yeah, Lisa, I think the thing that we've been trying to hammer in for a long time at this point is that it's not about the absolute level of rates so much as it's about the rate of change in those interest rates and the direction of travel. And up until this point, the direction of travel has been higher. The rate of change has been pretty significant, and we haven't really known where we were going to land. That makes it extraordinarily difficult to price those longer duration assets. Now that we have a little bit more clarity about where exactly the Fed is going to land, and I do think the Fed is basically done at this point, it could be taken as a signal by the market that, look, it's off to the races for some of these growthier companies, some of these technology-oriented companies. I'd say the messaging, though, Lisa, hasn't changed a whole lot there, and the underlying point is quality, sort of regardless of where you're looking within the equity market.
How do you distinguish quality in big tech? Does it go to social media versus nuts and bolts, iPhones and iPods, or iPads, I should say? iPods no longer exist in our rhetoric, but really this does raise a question, right? How do you identify what has staying power in a rapidly changing world?
Yeah, nuts and bolts, I like the way you put it, of physical assets that are produced by some of these companies, things that consumers are going to buy that are tangible, always something good to look at. Of course, there is room for innovation in the digital space, but what we can't be looking at here is those ultra-speculative, ultra-long-term growth stories. We need to have some, at least, whisper of the potential of profitability coming at some point in the near term, 12, 24 months, something along those lines. No longer is growth at any price a reasonable style of investment strategy, because even though the Fed may be landing a little bit quicker than we would have thought and at a lower level than we would have initially thought, the era of free money, of rates going back down to zero, I think is long behind us for quite some time. So the strategy around there has to change a bit.
There's also this issue of how do we know that we're going to get some kind of landing that's just hard enough to kill inflation, but just soft enough to allow some of these trades to continue. Morgan Stanley's Seth Carpenter weighing in on this over the weekend, saying if the disruption in the banking sector delays an extension of policy tightening, then a soft landing still is possible. But the downside risks have gotten bigger. The no landing notion never made any sense. Central banks were always going to force a landing one way or another. Jack, what's your sense of how significant this landing is likely to be if the Fed has paused where it has and we don't see more banking stress that is materially more than what we've already seen?
Yeah, I would agree, first of all, that no landing scenario was always kind of silly. We knew there was going to be a landing. We just didn't know necessarily how hard it was going to be. You know, I can see this environment, Lisa, where the Fed is able to sort of thread the needle and figure out a soft-ish landing. And the way that I get there is by looking at what's going on with the labor market. Just an enormous amount of excess demand out there that could, in theory, be sopped up by higher interest rates. At the same time, though, we do have financial conditions tightening pretty notably on the back of this banking crisis, and we have a Fed that hiked last week, and I don't think it necessarily should have done that. It's sending the wrong signal to markets about the direction of interest rates, and that could potentially lead to a downturn in consumption as we move through this year. So I think recession probabilities have probably crept up net-net, given everything that's happened over the last 3 weeks, but I do still think a soft landing is possible. Biggest story here, though, Lisa, is that even if we do get a recession, given the fact that there are no major imbalances in any of the cyclical parts of the market, things like housing or CapEx, whatever recession that may come our way, I don't think is going to be particularly severe.
Let's get a little philosophical, and I apologize to everyone for this, but Jack, you just said that they were setting the wrong signal to markets last week when they hiked rates at the Federal Reserve, and yet they might have sent a signal. The market didn't get it. If the market doesn't get the signal, if the market gives you a different kind of pricing, does it matter, right? If you hike into a vacuum of people who are basically betting in the other direction, did you hike at all? You basically have 100 basis points of rate cuts baked into the market by the end of this year and early next, despite some of the pushback that we saw from the Federal Reserve. So does it matter what the Fed does if the market's basically calling their hand and not believing them?
And maybe this commentary is coming from my place as a very frustrated market strategist trying to make sense of what the Fed is doing. You know, the rhetoric out of Jay Powell last week, I just think made absolutely no sense. You know, he acknowledged that financial conditions had gotten tighter. He acknowledged that the banking crisis had added uncertainty to the environment. I don't think either of those statements justifies the rate hike. But you're right, Lisa. I mean, the markets are still pricing in cuts by the end of this year. I think we are going to sort of split the difference between what the market is saying and what the latest dot plot is telling us, which is an additional 25 basis point hike. That's why I think we're going to kind of settle out and say no more rate hikes this year, but holding steady through the end of 2023 with cuts starting to emerge in 2024.
Jack,
markets are going to come in line with this.
You said something that was really important, and I want to just follow up on this quickly. You said that it's the pace of rate hikes that matters, and if we've hit an end to the rate hiking cycle, that will give stability to a lot of names. Does it give stability to the overall index? Does it give a sense that we could potentially rally from here substantially?
I think it does. I mean, we still need to see just how hard this landing is going to be when the Fed does land. If it's a short, mild, mellow kind of technical recession, the earnings drop will not be significant, will likely be short-lived, and markets are forward-looking, Lisa, right? So perhaps they can look through maybe the next 6 months of pain and focus in on that light at the end of the tunnel. However, if this recession ends up being a little bit worse than we would expect, and if we do end up getting a pretty significant one, that has implications for earnings that aren't particularly encouraging. That means that we could see a further move lower from here. My base case is that clarity on interest rates means that we have at least a modest upward pressure on markets, but there are some things that could go wrong here, I think.
Jack Manley, thank you so much for your perspective. Coming up, big tech strengthening its ties with China, even as U.S.-Sino tensions simmer.
We're talking about less tech earnings, problems with China. It's a risk. Think about semis. It's nearly a third of the semis market, and clearly this isn't helping. That's going to be shaving off some of that growth.
That conversation coming up.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
We're talking about less tech earnings, problems with China. I mean, we could have had this conversation, 6, 9, 12 months ago. It's a risk. Think about semis. It's nearly a third of the semis market, and clearly this isn't helping. That's going to be shaving off some of that growth. What's new here, I think, is the accelerated growth slowdown, the decline in bond yields. That's what I think we're, resetting for.
Tensions flaring between Beijing and Washington with all eyes on TikTok. The U.S. just one in a growing list of countries moving to block the Chinese-owned app. This as big tech continues to strengthen its ties with China. This is the sort of duality that's going on. Apple CEO Tim Cook meeting with China's commerce minister to discuss supply chains after saying at an event over the weekend, quote, "This has been a symbiotic kind of relationship that I think we both enjoyed." Bloomberg's Ed Ludlow joining us now from San Francisco. Why is Tim Cook, Ed, going to China, going to Beijing at a time of rising tensions, and how much of a liability is it?
Yeah, because China is an increasingly important market for Apple. Wang Wentao is relatively new to his role as the commerce chief in China, appointed this year. To the best of our knowledge, Tim Cook has not visited mainland China since pre-pandemic times in 2019. This is part of the China Development Forum. It's basically the government showcase for the economy since it lifted restrictions from a COVID-0 perspective in December. Cook is not the only executive to meet with Wang Tao. Others, including the CEO of Mercedes-Benz, for example, have been. But at the end of the day, it boils down to China, Greater China, representing 20% of Apple's sales. And you kind of hit on the key point of discussion, which for Apple is supply chain. We've discussed the story endlessly on this program that in the depths of the second wave of COVID in Guangzhou, for example, Apple came to quickly realize that its supply chain was incredibly concentrated for the high-end Pro models of its iPhone handset. What has happened subsequently is Apple looking to diversify its supply chain away to nations like India and Vietnam. But for the time being, China's still important. So that was a big topic of the conversation. The word stability doing a lot of work in that statement from China. But Tim Cook also visiting an Apple store and meeting with customers there in mainland China as well over the weekend.
Ed Ludlow, thank you so much. U.S.-listed China tech on the move this morning. Alibaba fluctuating between gains and losses. On the news that billionaire co-founder Jack Ma has returned to China. Joining us now is Bloomberg's Isabel Lee. Isabel.
Hi, Lisa. Yes, Ma's move or resurfacing is definitely having an effect. The billionaire first disappeared from public view in 2020 after publicly criticizing Chinese regulators. But on Monday, news surfaced that Jack Ma appeared back in China, visiting a school he founded and talking to staff there about topics including like ChatGPT and others. And analysts say that Ma's reappearance will be positive for the sentiment because they say this will be a regulatory normalization. So you're right, Alibaba is fluctuating between gains and losses. We have the broader index also shedding weight. The Nasdaq Golden Dragon Index is slightly higher. We have the Hang Seng also up and MSCI China also up. So how did we get here? Jack Ma's resurfacing comes as China tries to pitch itself as a hospitable place for business, and that's after a sweeping crackdown on the tech sector, Ma's companies included. The billionaire has been traveling across the world from Vienna to Tokyo to Hong Kong, and that's when Chinese authorities persuaded him to come back and to try to make their case. But Bloomberg reports that Ma is retreated from his companies to focus on agri-tech research, so it remains to be seen, and we have Ma even telling his executives in Alibaba and Ant not to obsess too much over his return. So definitely lots of things unfolding here, but we'll look out for Chinese tech stocks.
Isabel, thank you so much. Let's take a look at some of the other price action this morning, including, and I just mentioned that the Nasdaq 100 has risen 20% from its low in December 2022. Let's head over to Bloomberg's Kaylee Lyons to take a look at what's moving today, Kaylee.
Well, Lisa, it's so interesting that that headline crosses, and yet within the sector composition of the S&P 500, it is actually technology and tech-heavy sectors that are underperforming today. Granted, it is a broad-based rally. Pretty much everything is in the green, but communication services only up about 0.1%, and information technology up only by about 0.4. So that is actually underperforming the broader market, which is up about 0.8%. Toward the top of the pile, though, actually at the very top, you have the financials. The financial sector as a whole up 1.8%, and it is those regional banks outperforming. The regionals index up more than 4%, and a large part of that is thanks to the moves we are seeing in the likes of First Republic, up about 19% on more hopes of support from the U.S. government, allowing it more time to figure out its balance sheet. And then First Citizens up a whopping 43% after it agreed with the FDIC to buy $72 billion of SVB's assets at a discounted rate of $16.5 billion. Pretty good deal, and the market seems to like it today, Lisa.
Kaylee, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. As Kaylee was talking about, we are seeing a rally. And on the flip side, you are seeing yields creep just a touch higher now, looking for a 4% Fed funds rate in January of 2024. So still pricing in those rate cuts and that NASDAQ 100, even though it is underperforming the S&P today, up about 20% since its low in December. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Bloomberg The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Taking a look at the markets, you are seeing that outperformance continue in the S&P, up to 0.6% versus a 0.3% gain that you're seeing in the NASDAQ. If you take a look at what's moving, it really is what we're seeing in the banking stocks. We are seeing yields higher, markedly higher. Two-year yields 3.95%. But if you take a look at the bank stocks, that's where the action is. First Citizens shares are absolutely roaring. 43% gain. First Republic, PacWest, Western Alliance, all surging on the heels of a bit of stability. Time now for the trading diary. You need to be watching this week. Fed Governor Philip Jefferson speaking at an event from Virginia at 5 Eastern. 2 days of bank hearings on Capitol Hill kicking off on Tuesday. More Fed speak coming from Barkin and Collins on Wednesday, followed by Williams, Waller, and Cook on Thursday. And finally, rounding out the week with U.S. GDP and another round of jobless claims. What data is going to matter? Last week, we were talking about how the data doesn't matter anymore. This week, will that PCE, that core metric on inflation, really start to matter a whole bunch more? This was Countdown to the Open. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalition